Friends, welcome back to our channel OMSAI Bhojanapalli.
In the previous class, we discussed about volatility and duration of a bond. Today we will be discussing annuity bond, perpetual bond and zero coupon bond. Small issues only. For all these three types of bonds, we will see how to calculate value, YTM, duration and then volatility. Nothing actually is going to change in our discussion. The concepts are going to be almost same only, just a little bit changes in calculations, that's all. We'll do these three bonds, these four concepts. Once we complete that, then today we'll be doing an area called as bond immunization strategy. What is bond immunization and how it protects the yield? All these issues we'll be doing, and we'll try to do 3 problems in the workbook relating to the bond immunization strategies. Next class we will complete the concept called as forward rates and then convertible bonds. In one more class, the remaining bond concepts will try to complete it. So I hope you all are revising the foreign exchange management chapter or not. Whatever has been completed till now, you may not be able to do the currency options, futures and swaps. Apart from that, the other areas in Forex we have already covered. So please try to solve all the problems given in the end of the workbook. In practice problem segment, also start doing problems from other sources which you have. Okay, now let us summarize what has been discussed in the bond chapter till now before we continue with the other types of bonds. First of all, we saw that any company requires finance for investment. This can be broadly procured from 2 sources, equity and then debt. The investment generates return and the debt provider asks for a fixed income while equity opts for a variable income. So there are 2 securities in the market, fixed income securities and then variable income securities. Variable income securities we call as equity shares. Fixed income securities are so many types, but popularly we call it as bonds. How we have a share traded in the share market, corporate bonds, government bonds are also traded in the market. So above the bond concepts only we started discussing in this chapter. The structure was as follows. We saw there are 4 types of bonds: plain bond, annuity bonds, perpetual bonds, zero coupon bonds. Plain bond gives you coupon for n years and redeems in nth year. Annuity bond pays installments or annuity every year, which includes a portion of principal and interest on outstanding principal. Next, the perpetual bond pays only coupon, does not redeem. It pays coupon forever. And zero coupon bond doesn't pay coupon but pays only the maturity value. We saw that we will be discussing 4 concepts for all the 4 types of bonds, namely value of a bond, the yield to maturity, the duration and volatility. Then we said we will also discuss about other issues in the bonds, namely the realized yield to maturity, bond immunization, horizon analysis, forward rates, convexity of a bond, convertible bond, bond refunding decisions are all the other issues I said we will be discussing in this chapter. Here, for a plain bond, we completed the value, yield, duration and then volatility. Simply, what is the value of a bond? Common definition, present value of the future cash flows from the bond discounted at required rate of return of the valuer. So here we saw there are 2 aspects that influences the value. One is the cash flow the bond is giving and second is the required yield of the investor. The bigger the cash flow, more the value, lesser the cash flow, less the value. But these cash flows are projections. It all depends on the credit rating of the bond issuer. In that case, the risk of the cash flow is represented through the required rate of return or the discount rate. Yeah, Government of India bond may be rated higher than a corporate bond, right or not? In that case, higher the risk, more the discount rate, lower the risk, lower the discount rate. So the risk and return gives you the value of the bond. We saw that we will value a bond and compare with the market value. If the market value is more, the bond is overpriced. If the market value is less, the bond is underpriced. Overpriced bond, you do not buy it, you buy the underpriced bond. Then we discuss about the concept of yield to maturity. You pay a price for a bond and purchase it, and the bond gives you a cash flow. Somebody asks you what is the return the bond gives you. What we do, you calculate the IRR and say this is a return per annum the bond is giving. That IRR only we call as yield to maturity. It is a return the bond gives its bondholder, provided he holds the bond till maturity. That's a very important sentence which will be enunciated today much more elaborately. Okay, what is yield to maturity? It is a return the bond gives its bondholder, provided he holds till the maturity. This YTM can also be approximately calculated using two shortcut formulas. Yield to maturity is equal to interest after tax plus amortization divided by average price, or interest after tax plus amortization divided by weighted average price. Average price is S plus M by 2. Weighted average price is 0.6 S plus 0.4 M divided by 2. S is the subscription price or purchase price of the bond. 0.6 S plus 0.4 M. Sorry. S is the subscription price of the bond and M is the maturity value of the bond. This is regarding the formula calculation. Formula is very simply capturing two returns. A bondholder gets a return from the interest as well as from the capital gains. If he purchases a bond at a lower price, get it redeemed at par, then he will be having a capital gain. If he purchases at a price other than par value and get it redeemed at par, he will be having a capital loss. We also saw that when a bond is trading at par, redeemable at par, then the yield to maturity is simply its coupon rate. But when a bond trades at premium and redeemed at par, the YTM will be less than the coupon, and third case is vice versa. This is what we discussed regarding the yield to maturity. Then we saw how to calculate value and yield to maturity for non-annual coupons. Nothing great, convert everything into periods and then do the calculations. We discussed about duration. Duration of a bond is the weighted average duration of the bond cash flows, where the weights are the proportion of the discounted cash flow of the bond to the price of the bond, where the discount rate should be the yield to maturity. To put it simply, we have years, we have cash flows, we discount the cash flow using YTM, we'll be having discounted cash flow to price, find out the proportion to years gives you the duration. The duration can also be found out using formula. The formula for duration is 1 plus y by y minus 1 plus y plus t into c minus y divided by c into 1 plus y power t minus 1 plus y is the formula for duration of a bond. So the formula is very helpful if the period is too long or the bond is non-annual. Then we saw what is really a duration. One crude way of saying is average period for which my money is blocked in the bond. But a refined way of saying is it is the optimum bond holding period that protects my yield, which we are going to discuss in today's class, immunization. Other way to define it is a working note for volatility. What is volatility of a bond? Duration divided by 1 plus yield to maturity. A volatility of 3% means when the yield to maturity changes by 1%, the bond price inversely, approximately changes by 3% is the meaning of volatility. We saw the duration and volatility calculation for a plain bond and also for a plain bond which is non-annual coupon in the last class. With that we completed. Respond, yes or no? Now, we move on to the other small bond concepts like annuity bond, perpetual bond and zero coupon bond. Complete them quickly another 1 or 1.5 hours and then move on to the immunization strategy. Everybody up to this what has been done in this chapter, are you comfortable? Now, ultimately if you see, we are not discussing anything very great. IPCC cost of capital chapter only is repackaged in a different manner in this bond valuation. Can I proceed now? See. Give the heading concept of annuity bond. Concept of annuity bond. Okay, shall we start now? I will start with a small IPCC time value of money discussion. That is called as EMI. We shall study in the IPCC about the concept of EMI. We will discuss about that. That will convert into a annuity bond concept and then continue our discussion. Can I start or not? Now. Okay, concept of EMI. EMI is equated monetary installment. Okay, now it has become monthly installment because people pay monthly, but EMIs can be quarterly, annual also. Can I proceed? Now, take a small simple example. A bank has given a loan to a person for rupees 1 lakh. The interest the bank wants to earn on this loan transaction is 10%. The term of the loan is 3 years. Simple data. Now, you are the borrower. You have to repay the bank. You want to repay in equal installments. In what installment? Equal installments. How much will you pay every year? Tell me. Good morning, friends. Is a question ketamba? Okay, now tell me 1 lakh you have borrowed from the bank. The bank is requiring a 10% interest and the loan is what? 3 years. You should repay the loan or not? Yes, Sulupa. Loan should be repaid, should not be NPA. You should be what? Repaying the loan. Okay. So the loan should be repaid. Tell me, you want to repay equally. Tell me every year how much you will pay to the bank? 33,333. You can pay equal installments 33,333 for the bank every year, provided bank gives you interest-free loan. Yes or no? Who will pay interest? Yeah, right or not? Now, my installment should be equal as well as you should recover the interest and then what? Principal. Such an equal installment only we call as EMI, equated monetary installment. Did you understand or not? Now, the EMI is calculated as follows. EMI is equal to loan amount divided by annuity factor. Very simple. If I divide the loan amount by 3, that means year 1, year 2, year 3, I have 111 rupee value where the discount rate is 0%. Are you following what I am saying? But if the discount rate is 10% or something, year 1 is not 1, it is 0.9091. Year 2 is not 2, it is what? 0.8264 and so on. Instead of dividing the 1 lakh by 3, I should divide the 1 lakh by what? Annuity factor for 3 years. Ennappa, right? Do you understand? Now, again I ask you, how much you borrowed? You borrow how much of Asia? 1 lakh. Bank says interest-free loan. What bank says what? Interest-free loan. What is the discount rate? 0%. What discount rate here? 0%. 1 rupee after 1 year. Today it is worth how much? 1 rupee. In a discount by what? 0%. 1 plus R is 1 plus 0. In a price or not? Now, 1 rupee after 2 years you pay. What is the value today? 1 rupee. 1 rupee after 3 years. What is the value today? 1 rupee. That means today's discounted amount should be how much rupees here? 3 rupees. Yes or no? In that case, the EMI will be 1 lakh divided by what? 3. As that 33,333 will be the EMI. If the interest rate is 0%, right or not? But my interest rate is 0% or 10%? 10%. That means 1 rupee after 1 year is today how much? 0.9091. 1 rupee after 2 years is today how much? 0.8264. 1 rupee after 3 years is today how much? 0.7513. I should not add 1 plus 1 and then use it for denominator. Add what? 0.9091 plus 0.8264 plus 0.7513. The total of factors we give a name. What the name? Annuity factor. Yes or no? Sigma PDF is equal to annuity factor. Everybody comfortable or not? No. If you don't understand, another way to understand is very simple. See, here cash flow, annuity factor at 10% discounted cash flow. Okay. Now, I am going to pay to the bank for how many years? 3 years. Alright, 1 to 3 years. I am going to pay how much EMI? X rupees. I am going to pay as EMI. I want to find out the present value of the payment. I want to find out the present value of the payment. Singular, annuity cash flow, annuity. Multiply by present value, annuity factor. 10% of the annuity factor here. 2.48669 some number. Okay. So the discounted cash flow is 2.4869x. This discounted cash flow should be equal to what amount? Loan amount. Then only it is said to have been repaid. So I say 2.4869 into x should be equal to how much loan amount? 1 lakh. That means what should be the EMI here? It is 1 lakh divided by 2.4869. Respond. Are you following or not? Now, this x only, I call it as what? EMI. And this number is nothing but 1 lakh is what? Loan amount, and this is called as annuity factor. EMI is equal to loan amount divided by annuity factor. Up to this. Okay. Now, good morning friends. Ultimately, what we discuss is EMI is equal to loan amount divided by annuity factor. Accept or not? No. So let us calculate here. EMI is equal to what's the loan amount? 1 lakh. Remember what is the annuity factor? 2.4868 or the 69 as the case may be. We got EMI as 40,211. Can I proceed or not? Now, tell me. When I pay the bank 40,211, 40,211, 40,211 for how many years? 3 years. The bank would have got from me what? 1 lakh rupees loan as well as what? 10% interest on the outstanding loan. Respond. Yes or no? Let us see how this EMI should be split into principal portion and interest portion. It is a very routine calculation later in the leasing chapter also. We can just have that discussion quickly. Okay, now see. Let's start with the first. Year 1. What is the loan amount outstanding at the beginning of year 1? 1 lakh. On that, how much percent interest? 10%. What is the interest amount? 10,000. At the end of the first year, I give my first check to the bank. For how much rupees? 40,211. In that, how much goes towards interest? 10,000. What is towards principal? 30,211. End of first year, my principal outstanding will be still 1 lakh. Less than that, less than that. What is the principal outstanding? 69,789. Right or not? No. Second year, my loan amount is how much? 69,789. I pay interest on the 1 lakh outstanding principal. What's the interest amount? 6978 or 79 as the case may be. Second year end, I give another check for how much rupees? 40,211. In which the bank takes how much interest? 6978. How much adjusted for principal? 33,233. Second year end, the principal will be still 69,789. Less than that, less than that. What the principal outstanding? 36,557. Third year, the opening principal is 36,557. What is the interest percentage? 10%. What is the interest on that? 3656. I give another check for 40,211. In which 3656 goes for what? Principal interest. What towards principal? 36,555. Now the principal outstanding is 36,557. I have repaid how much? 36,555. 2 rupees write off. Yes or no? What is the amount here? 0. That's how the EMI works. Are you all following or not? Yes or no? So the 40,211 has recovered. If you total this total will be 1 lakh principal. Also has paid for me the interest on the outstanding principal. Is what we call as the concept of EMI. First issue. Everybody following or not? No. Very simple. EMI is nothing but annuity installments. EMI is nothing but what? Annuity installment. Where the EMI is calculated using the formula loan amount divided by annuity factor. Respond yes or no? This EMI recovers principal as well as interest. And principal as well as interest on outstanding principal, where the amount that is going to be paid every time will be an equal amount. Everybody up to this, are you following or not? With this, we complete a small concept called as EMI. Can I proceed? Now, copy this before you go for the next stage of discussion. Write down first facts. Give the heading concept of EMI. The annuity bond itself, we can just call this as part 1, concept of EMI. Concept of EMI. Concept of EMI. Please copy this quickly. Finish copying, huh? Right, EMI is equal to loan amount divided by annuity factor 10% 3 years. EMI is equal to loan amount divided by annuity factor 10% 3 years. Loan amount divided by annuity factor 10% 3 years. 1 lakh divided by 2.4868. 1 lakh divided by 2.4868 is equal to 40,000 to 11. EMI is 40,000 to 11. 40,000 to 11. Next. This EMI of 40,000 to 11, continue writing. This EMI of 40,000 to 11 recovers. This EMI of 40,000 to 11 recovers the entire principal amount to the bank. This EMI of 40,000 to 11 recovers the entire principal amount to the bank and also make the bank earn and also make the bank earn an interest of and also make the bank earn an interest of 10% on outstanding principal and also make the bank earn at an interest of 10% on outstanding principal. Interest of 10% on outstanding principal. Are you clearly understanding the discussions or not? No. This can be illustrated as follows. Please copy this. First year the 40,000 to 11, tell me everybody don't write, first tell and then write. First year the bank, how the bank treats the 40,000 to 11? It takes 10,000 for interest and adjusts 30 to 11 for principal. Second year what the bank does with the 40 to 11? Takes 6978 for interest, adjusts 33,000 to 33 for principal. Third year how it treats the 40 to 11? Takes 3656 for interest and 36,555 for principal. If you see, as the years progresses, the adjustment towards interest reduces, principal increases, because when you start repaying, the outstanding amount reduces. So do the interest payments also. Respond. Are you following? Now copy this slide quickly, please. Finish copying up. Very simple. Suppose you want to have the monthly EMI. Very simple. Annual or non-annual? Non-annual. Convert everything into what? Periods. Loan amount divided by not 3 years, 36 periods, and don't write 10%. It is 0.83% per period. You'll be getting the EMI. That's all. Very simple, yeah. If it is annual divided by, treat the numbers in years. Non-annual, treat the numbers in what? Periods. For everything, the same logic. Can I proceed further? No. Up to this. Finish copying. Yes or no? Yes, Okay, can I proceed? Now, let us convert this into a bond transaction now. Very simple. Now, for the bank, this is an investment liability. The bank is investing 1 lakh because giving a loan, it is investing what? 1 lakh and getting 40 to 11, 40 to 11, 40 to 11. Okay, now suppose the customer is a company. Customer is what? Company. A company wants a loan of how much base? 1 lakh rupees. Can approach a bank and apply for a loan and procure a loan for 1 lakh rupees and pay the bank EMI how much base? 40,000 to 11. Respond, yes or no? Company should raise loan only from bank, can raise it from public also or not? Public also. Instead of going to the bank and getting money, they can go to what? Public and issue bond. Are you following what I am saying? Now, this company can issue what? An annuity bond. Issue what? Annuity bond. Where the company will receive in year 0 how much a base? 1 lakh and it have to pay how much a base? 40 to 11, 40 to 11, 40 to 11 for 3 years. Such a bond will be called as what bond? Annuity bond. That's all. I am just converting the EMI into annuity bond. You are the bond holder. You are the bond holder. Today, how much you pay to buy the bond? 1 lakh. Year 0 all the investment here? 1 lakh. That's a bond price. Yes or no? And how much you get every year? 40 to 11, 40 to 11, 40 to 11. Tell me that 40 to 11 is a coupon redemption. Coupon and redemption. It has got coupon of 10% outstanding principal as well as what? Redemption. Annuity bond pays every year installment which requires coupon as well as what? Redemption. That's all. Everybody yes or no? Nothing great. This is what we call as an annuity bond. How bank charges EMI. As a bond holder, I charge from the corporate issuing bond what? EMIs. I'll receive the cash flows not as coupons and redemption. I'll receive the cash flows as what? Coupon and redemption every year on an outstanding basis. This is what we call as the annuity bond. Everybody following or not? Now, very simple. What is the value of an annuity bond? Present value of the future cash flows. For example, this bond gives you what cash flow? 40 to 11, 40 to 11, 40 to 11 for 3 years. If your required yield is 10%, value of the bond 1 lakh. The year required yield is what? 12%. The yield will be what? Something different. Very simple. Value of a bond is present value of what? Future cash flow. Discounted required yield to maturity. Respond. Are you following or not? Now, like that, let us start continuing doing the areas. So it may be a little bit lengthy, but still, just for clarity, we do it elaborately. Can I proceed? Now, write down. Next. Loan made into a bond. Let's write together. We'll write and discuss. Loan made into a bond. Loan made into a bond. Loan made into a bond. Required yield 10%. There's an annuity bond trading in the market where the investor wants how much percent? 10%. Term 3 years. Required yield 10%. Term 3 years. Annuity rupees 40,000 to 11. Annuity rupees 40,000 to 11. Rupees 40,000 to 11. Calculate the value of annuity bond. Calculate the value of annuity bond. If the yield changes to 12%, if the yield changes to 12%, what is its value? If the yield changes to 12%, what is its value? If the yield changes to 12%, what is its value? Okay. Tell me, annuity bond should you buy only from company? Can you go to the market and purchase? There is a primary as well as what? Secondary market. Don't think that this bond is a 3-year-old bond. It may be a 6-year bond. It may be what? 6-year bond. Already 3 years might have what? Elapsed. Still how many years more? 3 more years to maturity also can be that. Yes or no? You go to the stock exchange and see an annuity bond which is giving how much annuity? 40,000 to 11 annuity. We are having a maturity how many more years? 3 more years. You want how much percent return? 10% return. Now they ask you to value the bond. Everybody yes or no? Tell me. Very simple. What is the value of a bond? Present value of the future annuities. What is the one is what? Present value of the future annuities. So I want to earn how much return? 10% return. In that case, what is the value of the bond? Can I present or not? Right solution. Right solution. value of a bond is the present value of the future annuities. Value of the bond is the present value of the future annuities discounted at. Value of the bond is the present value of future annuities discounted at the required yield of the investor. Discounted at the required yield of the investor. Discounted at the required yield of the investor. Everybody, shall I proceed or not? Down. Write down. Here, let's write together. Here, events, cash flow. Tell me how much percentage? Annuity factor at 10%. Now I required yield is 10% at 10%. Discounted cash flow or value of bond. Annuity factor at 10%. Value of bond. Here I get the annuity for 1 year or 3 years or 3 years. How I'll write? 1 to 3. Here 1 to 3. What is that get? Coupon or redemption or annuities? Annuities. I get installments. Every year I get installments. How much I get? 40,211. This 40,211 investor fixes, company fixes. It is an agreed amount in the bond indenture itself. Indenture means the bond contract itself. The amount will be agreed. Nobody can change. Are you fine or not? How much is 40,211? What is the annuity factor for 10% 3 years? 2.4869 or 68 as the case may be. 2.4869. What is the value of the bond? 1 lakh. Value of the bond is 1 lakh. Now, answer my question. For this annuity, from this annuity, if I want a 12% return, how much percent return? 12% return. Will I pay 1 lakh, more than 1 lakh, less than 1 lakh? Why less than 1 lakh? Because 1 lakh gives you only 10% IRR. I want how much? 12%. I'll pay less than 1 lakh. How much it is the next issue. Can I proceed? Write down once again. Here, events, cash flow. Here events, cash flow. Annuity factor at 10%. 12%. Annuity factor at 12%. Value of bond. Here cash flow, annuity factor at 12%, value of the bond. 1 to 3 years. 1 to 3 years. I get what? Installments. Will the installment amount change or not? No. How the bond coupon will not change in plain bond? Like the installment amount will not be what? Changing. It is an agreed amount given in the indenture. What installment amount? 40,211. Tell me what is the annuity factor? 12% 3 years calculator. What's the number? 2.4018. Number is 2.4018. 40,211 into 2.4018. If you multiply and tell me what is the number here? 96,579 or 580 as case. 96,579. 96,579. Now, tell me, when I invest 96,579 in the secondary bond market, I jump into the market and pay how much rupees as a price? 96,579 and get 40,211 as coupon. Tell me how much I earn? 12%. In other words, the 40,211 is capable of earning 12% interest on the outstanding principal, where the principal amount is how much? 96,579. Respond yes or no. Now, if I treat the principal as what? 1 lakh. If I pay 1 lakh price, you can earn only how much? 10% as the return on the investment. Everybody, are you following or not? So now, this bond value will change in the market on day-to-day basis. An annuity bond of 3 years will be trading in the market, in the stock market. Today, the bank interest may be 10% or the prevailing interest may be 10%. So, the bond will be trading at how much a base? 1 lakh. Suppose tomorrow RBI announces the interest rate change. Announces what? Interest rate change. But it hikes the base rate. Okay. In that case, all the interest rates will increase or not? Always interest rate change is mainly triggered by what? The Reserve Bank of India policies only. Say you may have heard, no, it has increased the interest rate by 25 basis points or decreased by what? 50 points and so on. When RBI triggers the interest rate change, everywhere interest what? Increases. Tomorrow the same 10% bond is trading in a yield of what? 12%. Will the public pay 1 lakh to buy that bond? Less than 1 lakh? Less than 1 lakh. Tomorrow the bond will be trading at how much rupees? 96,579. Everybody, yes or no? This is what we call as an annuity bond. Very simple, nothing great we have discussed. Can I proceed? Now, next is, it may be repetitive, but still I want to discuss, conclude it. Okay, now I want to calculate YTM. YTM now, I know the bond price, I know the annuity. You have to find out what? The return there. That is what we call as what? YTM. Can I proceed or not? Now, for plain bond, how many ways of calculating YTM? What are 3 ways of calculating YTM? Formula 1, Formula 2, IRR. Annuity, we don't have any formula. Straight away we have to only go for what? IRR calculation for calculating the yield to maturity. We don't have that interest plus what? Amortization. All those formula will not be present here. Can you present or not? Now, let's go to the next. Give the heading. YTM of an annuity bond. Underline that. YTM of an annuity bond. YTM of an annuity bond. Underline that. YTM of an annuity bond, underline that. Bond value is equal to 1 lakh. That is, in the market, the bond is now trading at what price? 1 lakh. If you want to buy the bond today, I have to invest how much rupees? 1 lakh. Term of the bond, 3 years. Has got 3 more years to maturity. Term of the bond, 3 years. Annuity, 40,000 to 11. 40,000 to 11. Right, point number 1, calculate YTM of the bond. Point 1, calculate YTM of the bond. Calculate YTM of the bond. Point 2, if the bond is trading in the market, if the bond is trading in the market, if the bond is trading in the market at rupees 96,579, if the bond is trading in the market at rupees 96,579, what is the yield to the investor? What is the yield to the investor who purchases the bond? What is the yield to the investor who purchases the bond at the above price? What is the yield to the investor who purchases the bond at the above price? What is the yield to the investor who purchases the bond at the above price? These are the 2 questions. Now, tell me, first 2 question, what is the bond value? 1 lakh. The bond is trading at 1 lakh. And what is the EMI or annuity the company has promised to give? 40,000 to 11. If I invest 1 lakh and get 40 to 11 for 3 years, what is my IRR? What is my IRR here? 10%. Don't say we have to calculate. 10% is given in the last problem. It's going to be what? New problem. I have to calculate the IRR. Now, if I buy the bond for what? 96,579. Will the IRR increase or not? Yes. Instead of 1 lakh, my investment reduces. When my investment reduces, return on investment increases. So now we have to calculate IRR for the 2 sums. Can I proceed or not? Now, write down. YTM, bracket IRR of bond. YTM or IRR of bond. We don't have shortcut formulas. I had only calculate the IRR. YTM or IRR of bond. Can I proceed now? Here, cash flow. Here, cash flow. I hope you all can write and understand simultaneously or not. I am just going very slowly also and repetitive also. Here, cash flow. You are the bond holder. You are what? You are going to be the investor. You go to the stock exchange and buy this annuity bond today by paying how much rupees? 1 lakh. Year 0, we have invested 1 lakh. Year 0, we have invested 1 lakh. Every year the company gives you some money or not? Yes. As a bond holder, what are you going to receive for the next 3 years? 1 to 3 years, I get 40,000 to 11. 1 to 3 years, I get 40,000, 211. Okay, tell me, if I discount that 40,000 to 11 at some rate, if I discount this 40,000 to 11 at what? Some rate, the discounted cash flow should be equal to what? 1 lakh. Then only the rate will be called as IRR, right or not? IPC portion here, right or not? What is IRR? The rate at which the discounted inflow will be equal to discounted outflow. Respond yes or no? So write down, IRR is a rate at which discounted cash inflow equals discounted cash outflow. IRR is a rate at which discounted cash inflow equals discounted cash outflow. Discounted cash inflow equals discounted cash outflow. Discounted cash outflow. Respond yes or no? Now, my question is, this inflow is a single cash flow, perpetuity, annuity, or multiple anyone? Tell me what is the formula for discounting annuity? Discounted cash flow is equal to what into what? Cash flow into annuity factor. Respond yes or no? No. Write down. Continue writing. Discounted cash flow is equal to cash flow into annuity factor. Discounted cash flow is equal to cash flow into annuity factor or percent n years. Discounted cash flow is equal to cash flow into annuity factor or percent n years. Now, I want my discounted cash flow to be how much rupees? 1 lakh. Now, today's value is how much? 1 lakh. 1 lakh is equal to, what is the cash flow? 40,000 211 into 1 lakh is equal to 40,000 211 into annuity factor. I have to find out the R no? R percent. How many years? 3 years. 1 lakh is equal to 40,000 211 into annuity factor R percent 3 years. Annuity factor R percent 3 years. That's right. Everybody comfortable or not? Now, rearrange. 2.4869. How I got that? 1 lakh divided by 40,000 211. 2.4869 is equal to annuity factor R percent 3 years. 2.4869 is equal to annuity factor R percent 3 years. Here we have to use the table. I have not given you the table. Very simple here. In an annuity table, have you all seen annuity table IPCC or not? In an annuity table, 3 numbers are given. In the top of the table, I will be given the interest rates. In the side, I will be given what? Years. In the center, I will be given what? Annuity factors. So the table has got 3 numbers. Namely what? Interest, years. In body of the table, annuity factor. Normally, we see the interest and years and find out the factor, yes or no? Now I have what? Factor and years. See against 3 years, where 2.4869, look at the top, I will be getting the interest. I cannot tell more than that. This is IPC say portions. Can I proceed? Now, in that case, the R is equal to 10%. Will be getting from the table. R is equal to 10%. We don't have a calculator way of calculating the annuity factor. Hence, the only thing to rely is on table. Exam gives you the relevant numbers. Okay, R is equal to 10%. R is equal to 10%. Now, tell me, the bond holder is earning how much return? 10% return on this bond. This is a yield to maturity. Right or not? Now. Next, YTM, once again write IRR of bond. YTM, bracket IRR of the bond. YTM, IRR of the bond. IRR of the bond. Year cash flow. Year cash flow. I change the question. Year 0, I purchase the bond at 1 lakh, less than 1 lakh, less than 1 lakh. Tell me the price you pay to purchase a bond. 96,579. I invested 96,579. The bond gave me for 3 years. How much rupees? 40,211. The bond gave me for 3 years 40,211. So I invested 96,000 and odd. I get 42,11 for every year for 3 years. This bond should have given me a return or not? The return is called as IRR. What is IRR? The rate at which discounted inflow equals a discounted outflow. Write down. At IRR, or IRR is a rate at which discounted inflow equals discounted outflow. IRR is a rate at which discounted inflow equals discounted outflow. IRR is a rate at which discounted inflow equals discounted outflow. Okay, please, all of you, tell and write simultaneously because I have to know whether you are following and writing or just copying. Okay, tell me what the first step. Discounted cash flow is equal to cash flow into annuity factor or percent n years. Everybody, discounted cash flow is equal to cash flow into annuity factor or percent n years. Discounted cash flow is equal to cash flow into annuity factor or percent n years. Participate. Next line. What next line? What discounted cash flow? 96,579 is equal to 96,579 is equal to what? 4211 into annuity factor or percent 3 years. 96,579 is equal to 4211 into annuity factor or percent 3 years. Bring this left hand side the 4811. What is the number? It is 2.4018 is equal to annuity factor or percent 3 years. 2.4018 is equal to annuity factor or percent 3 years. If we look at the annuity table against 2.4018 and 3 years, I get R as how much percent? 12%. That you have to see the table, go home and see it. R is equal to 12%. R is equal to 12%. Tell me, what is the IRR for this bond here? 12%. Person purchasing the bond at 1 lakh will get only 10% return. Purchasing the bond at what? 96,000 or not will be getting 12% return. Up to this, everybody following or not? No. So, I don't want to change the track, but just I wanted to sideline one issue and then come back to the bond. See, IRR we are calculating or not? There are 3 types of cash flows. How many types of cash flows here? 3 types of cash flows. Namely what? Single cash flow, annuity cash flow, perpetuity cash flow and multiple annuity. 4 types of cash flows. Sorry, right or not? Can I proceed? Now, in that, listen here. Already we have seen how to calculate IRR for a single cash flow. How to calculate IRR for a multiple and even. Now how to calculate IRR for what? Annuity. I just want you to consolidate the IPCC IRR portion now. Can I proceed? ரொம்ப simple, yeah? Now, we had one realized YTM discussion, right or not? If you remember, in that, I had a cash flow like that. Year cash flow. Year 0, if I am right, we had an investment of 86.59. Then we had 1 to 5 years, 5th year, all are reinvested, right or not? Now, at the end of the 5th year, if you see the realized YTM problem, I had a number of 174.16. This was one of the realized YTM problem we did. Yes or no? Now, for this we calculated an IRR of 15%. Ennappa, remember or not? This is an IRR for a single inflow because inflow occurs only what? Once. For that IRR, what is the modus operandi for calculation? Use a formula. Future value is equal to present value into 1 plus R power n. This was used to calculate IRR for the situation number 1. Yes or no? That is we should now onwards always calculate IRR for a single cash flow. For a single cash flow, use a compound interest formula to calculate the IRR. Response is or no? Based on that, I got 15%, and nth root how to calculate using calculator also has been discussed. Right or not? Now, situation 2. We had year cash flow. Year 0, I invested 86.59. 1 to 5, I got how much? 11. Year 5, I got how much? 100. Now, this is what cash flow? Singular, annuity, multiple and even? Multiple and even. Because annuity, it should be only about 11 rupees, 5 years. It's a multiple and even cash flow, right or not? Now, always for multiple and even, this is also having how much IRR? 15% we calculated now. How we calculate yield to maturity? It is using a guess rate. Using what? A guess rate. I always start with a guess rate. Can I consider 14% of IRR or 16% so on? I start with the guess rate and then calculate the IRR. This trial and error method for a multiple and even cash flow. Yes or no? But for the coupon bonds, it is very simple. Guess rate I calculate using the shortcut formula. Respond. Are you following or not? So, we have seen how to calculate IRR for a single cash flow. For a single cash flow, tell me the IRR computation procedure. Future value is equal to present value into 1 plus R power n. That method you follow for calculating the IRR, right or not? For multiple and even, always we start IRR on trial and error basis. You take an interest rate and check whether the interest rate is what? IRR. If it is not IRR, upwards or downwards, and then narrow the interest rate gap and find out the IRR. Respond yes or no. Now, in that case, in a plain coupon bond, it is an IRR for a multiple cash flow, but only advantage for us is, for this I can start the guess rate with help of what formula? Shortcut formula. Two cash flows, you have now learned how to calculate IRR, right or not? Now, third is this particular problem, situation number 3. Okay. In situation number 3, we had a bond year and then what? Cash flow. For example, year 0, I invested 96,579 for the bond. And what I get? 1 to 3 years, I got 40,211. Tell me, this is a cash flow with a singular annuity inflow. For this, we calculated IRR as how much percentage here? 12%. What is that formula used for calculating IRR? Discounted cash flow is equal to cash flow into annuity factor, where I know these two and I found out the annuity factor search for the interest. That's how we learned to calculate the IRR for the 3 types of cash flow. One more cash flow is what? Perpetuity. We'll be seeing through the perpetual bond later. Are you following or not? Now, tell me. 4 types of cash flows. In which we have completed how many cash flows? 3 cash flows. We learned how to calculate the IRR. Tell me how to calculate IRR for a single cash flow. All of you. Present value is future value is equal to present value into 1 plus R power n. How to calculate IRR for a multiple and even cash flow? Guess rate. That is calculated using the trial and error method. Use a guess rate. And for coupon paying bonds, the guess rate can be the shortcut formula rate. And for annuity cash flow, how we calculate IRR? Discounted cash flow into annuity factor gives you for annuity cash flow. So this IRR only we call as YTM in bond. We call as what? YTM. YTM for an annuity bond should be calculated using discounted cash flow is equal to cash flow into some number. Then the YTM of a say coupon paying bond should be calculated using the trial and error method using a guess rate, which can be obtained using the shortcut formula. And this is I'll discuss later for a 0 coupon bond. We'll be calculating IRR later. Everybody, are you comfortable or not? Now, can I proceed to the next stage? Now, annuity bond we are discussing. We just sidetrack. Let's come back to the annuity bond. Tell me, first of all, what is the value of an annuity bond? What is the value of an annuity bond? Present value of the future cash flows from the bond discounted at the required YTM. What is the YTM of an annuity bond? IRR of the annuity bond cash flow. Yes or no? Now you all should be knowing how to calculate value, how to calculate YTM. Ennappa, right? Respond. Yes or no? Now, the third is to calculate the duration of an annuity bond. Yes or no? Let's go for the duration calculation of annuity bond. Write down. Duration of an annuity bond. Duration of an annuity bond. Okay. See, I'll take the first example. See, year cash flow. Year 0, suppose I invested 1 lakh. The bond is trading at what price? 1 lakh. I take that example. And 1 to 3 years, the bond gives me how much of the base? 40,211. Answer my question. For this, they ask you to find out duration. They ask you to find out what? Duration. To find duration, the first step is to find what? YTM. Now, for this problem, have we calculated YTM or not? Yes. We calculated YTM as how much percentage here? 10%. Just now in the previous step, we calculated what? YTM. Now, I know the YTM. Next, I have to find out what? Duration. Tell me how to find out duration. Year, cash flow, discounted at 10%. I'll get the discounted cash flow total to the value of the bond. Find out proportion. Year into proportion gives you the duration. Can I proceed or not? Now, let's start doing the duration. Write along with me. Duration of an annuity bond. Year, cash flow, Present value factor at 10%. What is so great about 10%? YTM. Discounted cash flow, proportion, duration. Year cash flow, present value factor at 10%, discounted cash flow, proportion, and then duration. Can I start or not? Now, year 1, 2, 3. 1, 2, and then 3. Tell me the cash flow what again? 40, 2, 11, 40, 2, 11, 40, 2, 11. 40, 2, 11, 40, 2, 11, 40, 2, 11. What the present value factor at 10%? 9091, 0.9091, 0.8264, 0.7513. 9091, 0.8264, 0.7513. Tell me the discounted cash flow. 40 to 11 into 0.9091 gives you 36,556. 36,556. 40 to 11 into 0.8264 gives you 33,230. 33,230. 40 to 11 into 0.7513 gives you 30,211. Gives you 30,211. If a total, it should be obviously equal to the value of the bond, 1 lakh. If there is some mistake, it is due to rounding off. That's why I think 3 rupees difference. Some number, yeah, it is due to rounding off. Leave it. Can I proceed? Now, tell me proportion. 36,556 divided by 1 lakh. What a proportion? 0.3655. 0.3655. Next is what? 0.3323. 0.3021. 0.03021. Proportion into year gives you duration or not? 1 into 0.3655 gives you 0.3655. 2 into 0.3323 gives you 0.6646. Gives you 0.6646. 3 into 0.3021, that gives you 0.9063. 0.9063. If I total, the duration of the annuity bond is 1.9364. The duration is 1.9364. The duration is 1.9364. Everybody, are you following or not? No. Duration has got a formula also or not? Tell me, what is the formula for a duration? Tell me. 1 plus y by y minus 1 plus y plus t into c minus y divided by c into 1 plus y power t minus 1 plus y. Accepted? Now, this is a formula for a coupon paying bond. Get up. A plain bond, because in a plain bond, YTM influenced by 3 factors. Duration influenced by 3 factors. The yield of the bond, yes or no? Second is what? Coupon. Third is term. Yes or no? Yield, coupon, and then what? Term. The 3 numbers that gives you a duration. 1 plus y by y, y is there, and there is t is there. There is also what? C is there. So duration of a plain coupon bond is influenced by 3 factors: term, coupon, and then what? The yield to maturity. Yes or no? But annuity bond, one number will be missing. That is called as coupon. Now, there is no coupon for what? Annuity bond. Annuity bond has got only 2 numbers. One is term, another is yield. No, yeah, correct, huh? No. Because the company has started, that is, nobody said 10% annuity bond, 8%, nobody says, yeah, annuity bond gives you what? Annuity, it has got only yield and the price. It has got only what? Yield and the price. For a given term, it does not have a coupon. Yes or no? In that case, the duration formula should undergo a change or not. That formula should have only 2 items in it. One is what? Yield, another is what? Term. It will not be having a coupon. Everybody following or not? Isn't it correct, huh? First problem and all, we had a 10% bond, 8% bond, or a bond paying coupon of 8% and so on. In all this, I don't have a coupon because annuity bond does not carry a coupon. Everybody following what I am saying? No. Let's go for the calculation. Duration of a bond. Let me just put the formula and then you can just copy it. The formula becomes now much more simpler. It is 1 plus y by y minus t by 1 plus y power t minus 1. Tell me what is the formula? 1 plus y by y minus t by 1 plus y power t minus 1. Okay, write down the formula. Alternatively, Alternatively, duration can be calculated using the following formula. Alternatively, duration can be calculated using the following formula. Alternatively, duration can be calculated using the following formula. D is equal to, duration is equal to 1 plus y by y minus 1 plus y by y minus t divided by 1 plus y power t minus 1. 1 plus y by y minus t divided by 1 plus y power t minus 1. Can you do along with me? Now substitute numbers. What is the yield to maturity calculated? 10%. 1.1 by 1, 1.1 by 0.1 minus, now yield to maturity is 10% for this problem or not? 1.1 by 0.1 minus, what is t? 3 divided by 1.10 power 3 minus 1. 1.1 by 0.1 minus 3 by 1.10 power 3 minus 1. Tell me the simplified number. Anybody doing it or not? Do and tell me what's the number you're going to get. 1.9365 years. You get 1.9365 years. 1.9365 years. The same number you got here also is on 1.9364, that is 65 due to rounding off. 1.9365 years. This is the duration of what? Annuity bond. Everybody following or not? No. Last number is what? Volatility. What is the formula for volatility? Volatility is equal to what? Duration by 1 plus YTM. Exactly. Write down. Next. Volatility. Next, right? Volatility of the bond. Volatility of the bond. Volatility is equal to what by what? Duration by 1 plus yield. Volatility is equal to duration by 1 plus yield. What is duration you have? 1.9365 divided by 1.935 divided by what is yield here? 1.10. 1.9365 divided by 1.10. Tell me what is the volatility? How many days? 1.76 percentage. I'll call as 1.76 percentage. 1.76 percentage. Can you tell me what is the meaning of 1.76 percentage? If a yield of the annuity bond changes by 1%, the price of the annuity bond inversely approximately changes by 1.76% is the meaning of this particular discussion. Yes or no? No. You can go home and check it. Okay. There is something called as Malkiel's theorem. I will discuss it later. How approximate it is changes from bond to bond. We will discuss about the feature in the later stages. Okay. This is regarding annuity bond. Tell me how many bonds you have computed? 2 bonds. Now let us compare. Plain bond. What is the value of a plain bond? Present value of the future coupons and redemption discounted or what? The yield to maturity or the required rate of return. Okay. What is the value of an annuity bond? Present value of the future installments discounted or what? The required rate of return. Value over. Is or no? No. YTM for a plain bond can be calculated in how many ways? 3 ways. Shortcut formula 1. What is the formula? Interest after tax plus amortization divided by average price. Second formula is what? Interest after tax plus amortization divided by weighted average price. And the third method is what? IRR. But for annuity bond, we have to calculate straight away using what? IRR only. Annuity bond IRR, how you calculate? Discounted cash flow is equal to cash flow into annuity factor. Where you know discounted cash flow as a bond price, we know the cash flow as what? Installments. Find out annuity factor, and you know the years, find out the percentage. Yes or no? Now, next is duration of a plain bond. Duration of what? Plain bond. How many ways to calculate? 2 ways. One is, right, years, cash flows, discounted at what? Discounted at what? Yield to maturity, discounted cash flow, proportion, and then duration. The other way to calculate is the formula. What is the formula for duration? 1 plus y by y minus 1 plus y plus t into c minus y divided by c into 1 plus y power t minus 1 plus y. Accepted or not? No. And in case of an annuity bond, the same table method continues. But the formula is going to change. What the change to formula here? 1 plus y by y minus t by 1 plus y power t minus 1 is a duration formula. Volatility for a plain bond is what? Duration by 1 plus y. For annuity also is what? Duration by 1 plus y. So we have found out all these four for a plain bond as well as what? Annuity bond. Respond, yes or no? Two more bonds are there. Two more bonds, perpetual bond and then zero coupon bond. Can I move to the perpetual bond next or not? No. Give the heading, concept of perpetual bond. Okay, tell me, perpetual bond gives its bondholder redemption, gives only one coupon on the face value. There will be a face value that gives only the coupon to the bondholder. Respond, yes or no? This coupon will be given for 1, 2, 3 or how many years? Forever. That is going to be the perpetual bond. Can I proceed? Now, write down first. Value of a perpetual bond. Underline that. Same four concept, very small, quickly we can complete. Value of a perpetual bond. What are four things I want to discuss? Value, YTM, duration and volatility. That's all. Value of a perpetual bond. Required yield. Required yield 10%. Required yield 10%. For the bond of this risk class, I want how much return from the bond? 10%. Term perpetuity. Term perpetuity. Coupon 10,000. Coupon 10,000. The company has promised to give this coupon for how many years? Forever. Coupon 10%. Write down. Calculate value of the perpetual bond. Point number 1. Calculate value of the perpetual bond. Calculate value of the perpetual bond. Point number 2. Suppose the required yield for this bond changes to 12.5%. Suppose the required yield for this bond changes to 12.5%. The required yield for this bond changes to 12.5%. What is its value? What is its value? My question is, will its value increase or decrease? Because if I want more return, I'm willing to pay what? Less price for it. The value is going to obviously decrease. Everybody, can you start or not? Now, tell me, what is the value of a bond? Simple sentence, I ask you again and again, what is the value of a bond? Present value of the future cash flows. For a plain bond, what are the future cash flows? N-year coupons, N-year redemption. For an annuity bond, what are the future cash flow? N-year annuities or installment. For perpetual bond, what are the future cash flow? Infinite coupons. It can be what? Infinite coupons. You all should know present value of a perpetuity. Yes or no? Tell me, for perpetuity, discounted cash flow is equal to what? Cash flow by R. We discussed. For this only discussed time value of money earlier. What is for the perpetuity discounted cash flow? Discounted cash flow is equal to cash flow by R. If you all remember, I gave you an example, no? I promised to give you 1 lakh, 1 lakh, 1 lakh forever and ask a lump sum amount today. What you will ask? I said cash flow divided by R. That's what I calculate for the perpetual bond. Can I say perpetuity is the easiest to calculate always? Can I say write down first. Value solution, write solution. Year, event, cash flow, value of the bond at 10%. Year, events, cash flow and value of the bond at 10%. I don't have any factors and all for this. Year, events, cash flow, value of the bond at 10%. Tell me how to write years. 1 to what? Infinity. 1 to infinity. The bond keeps on giving every year. What are the event? Coupons. 1 to infinity, it is going to give me infinite coupons. At what amount? 10,000. The present value of this perpetuity is what? Cash flow by R. What is cash flow? 10,000 divided by 10%. 10,000 divided by 10%. The value of this bond is 1 lakh. 10,000 divided by 10%. The value of the bond is 1 lakh. Now, the coupon change, the yield change how much percent? 12%. You can write year events, cash flow, year events, cash flow, value of the bond at 12.5%. 12.5%, value of the bond at 12.5%. Value of the bond at 12.5%. Again tell me, first 3 columns will change or will not change? Will not change. The agreed amount in the bond indenture, yes or no? It is 1 to infinity, coupon 10,000. 1 to infinity, coupon 10,000. Tell me what is the value of the bond? 10,000 by 12.5% gives you 80,000. It gives you 80,000. If I pay 80,000 price, this coupon gives me how much yield? 12.5% yield. If I pay 1 lakh price, the coupon gives me how much yield? 10% yield. As simple as that. Everybody following or not? This is the value of a perpetual bond. Everybody, can I proceed or not? Now, next what I have to discuss? YTM. YTM of a perpetual bond. Underline that. YTM of a perpetual bond. YTM of a perpetual bond. Bond value 1 lakh. Suppose I buy the bond at a price how much rupees? 1 lakh. The price of the bond is 1 lakh. Bond value 1 lakh. Term perpetual. Bond value 1 lakh. Term perpetual. Coupon rupees 10,000. Bond value 1 lakh. Term perpetual. Coupon is rupees 10,000. Can I proceed above? No. Calculate YTM of the perpetual bond. Point number 1. Calculate YTM of the perpetual bond. Calculate YTM of a perpetual bond. 2. If the bond is trading at 80,000, point number 2. If the bond is trading at 80,000, then what is its YTM? If the bond is trading at 80,000, then what is its YTM? The bond is trading at 80,000 rupees, then what is its YTM? Understand the question or not? Can you solve the solution or not? Tell me. What is the YTM of a bond? What is the yield maturity of a bond? It's IRR. What YTM is nothing but what? IRR. What is IRR? The rate at which the discounted inflow equals what? Discounted outflow. Everybody comfortable or not? Write down solution. Solution. YTM bracket la IRR of the bond. YTM in bracket write IRR of the bond. Can I proceed? Year cash flow. Year cash flow. Today at what price I buy the bond? Yes, what price I buy the bond? 1 lakh. I invest 1 lakh. What I'm going to get? 1 to infinity is 10,000. 1 to infinity is 10,000. Now, tell me, if I discount this inflow of 10,000, it should be equal to what? 1 lakh. Then that rate is called as what? IRR. Write down. IRR is a rate at which discounted inflow equals discounted outflow. IRR is a rate at which discounted inflow equals discounted outflow. Discounted inflow equals discounted outflow. Shall I proceed now? Tell me what the formula. Discounted cash flow is equal to what? Tell me, yeah. Discounted cash flow is equal to what? Cash flow by R. For this perpetuity, right? Discounted cash flow is equal to cash flow divided by R%. In one batch and take the notebook Xerox, they put plus, the plus lepa division, okay. Apply your mind and write discounted cash flow is equal to cash flow divided by R%. See, there's a gap between that line and the 2 points, yes or no? So, it is cash flow divided by R%. Can I say, I know the discounted cash flow or not? Yes. How many days? 1 lakh is equal to, what is the cash flow? 10,000 divided by R%. 1 lakh is equal to 10,000 divided by R%. Very simple. R percent is equal to what by what? 10,000 divided by 1 lakh. R percent is equal to 10,000 divided by 1 lakh. What is 10,000 divided by 1 lakh is how much percentage? 10%. R percent is equal to 10%. R percent is equal to 10%. Very simple, yeah. For a perpetual bond, YTM is coupon divided by price. What is the YTM here? Coupon divided by price. What the price I pay? 1 lakh. What the coupon I get? 10,000. Coupon by price. Return divided by investment. Gives you what? Return on investment. Right or not? Right on. Next. To put it simply, for perpetual bond, yield is equal to for perpetual bond, yield is equal to what by what? Coupon divided by price. For perpetual bond, yield is equal to coupon divided by price. Yield is equal to coupon divided by price, which is equal to coupon divided by price. Already calculated. That's all. Can I proceed? Now, next. We change the price or not? YTM, IRR of bond. YTM, IRR of bond. Here, cash flow. Now I am buying the bond for how much price? 1 lakh, less than 1 lakh, less than 1 lakh. What the price I pay to buy the bond? 80,000. I pay 80,000 to buy the bond. Year 0, the cash flow is 80,000. Tell me, 1 to how many years? Infinite years. Due to the change in price, will the coupon change up? No. It is already agreed in the indenture. Yes or no? No. Tell me, what is the coupon? 10,000. 10,000. At IRR, discounted inflow is equal to discounted outflow. At IRR, discounted inflow is equal to discounted outflow. Discounted inflow is equal to discounted outflow. DCF is equal to formula cash flow by R percent. DCF is equal to cash flow by R percent. 80,000 is equal to 10,000 by R percent. 80,000 is equal to 10,000 by R percent. R percent is equal to 10,000 by 80,000. R percent is equal to 10,000 by 80,000. Is equal to how many days here? It is equal to 12.5%. Is equal to 12.5%. Is equal to 12.5%. Everybody, are you all comfortable or not? No. With this we have completed how many issues? 2 issues. Very simple. What is the value of a perpetual bond? Present value of the perpetual coupon. How to calculate present value of a perpetuity? Cash flow divided by R. Or yes or no? No. What is the yield of a perpetual bond? Coupon divided by price. Gives you the yield of a perpetual bond. As simple as that. Yes or no? No. The third is what? Duration. We cannot use table. I have tried infinite coupons or not. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. I'll keep on writing. Then goes up to what? Infinity. I cannot write a table approach for a say perpetual bond. No, yeah, written. But there exists a formula for calculating the duration. Much more simpler. See, duration of a perpetual bond. 1 second we can by heart the formula. It is 1 plus y divided by y. What is a perpetual bond? 1 plus y divided by y. What is yield to maturity in this case? 10% divided by 0.1. That gives you how many years? 11 years. Now, here I cannot say average holding period and all because I don't get redemption. Everybody following up? Now, how to understand this is, if I hold for 11 years, my yield stands protected. Immunization will be understanding this particular formula. Everybody following on? So understand that what is duration of a bond? Optimum holding period for a perpetual bond is, when you buy a perpetual bond, don't keep it for infinite year. Sell that bond after how many years? 11 years. It will be a good strategy for you. Everybody following on? So duration is how many years? 11 years. Write down duration of bond. Duration of bond 1 plus y by y is equal to 1.1 by 0.1. 1 plus y by y is equal to 1.1 by 0.1 is equal to how many years? 11 years. Is equal to 11 years. Volatility, no change. Next, right? Volatility. Next is volatility. Tell me the formula for volatility. Volatility is equal to what? Duration by 1 plus y. Next, give the heading volatility. Volatility is equal to duration by 1 plus y. Volatility is equal to duration by 1 plus y. In the sum, what is the duration of this perpetual bond? 11 years divided by, what is 1 plus y? 1.10. 11 divided by 1.10. Tell me, what is the volatility? How much percent is going to be? 10%. Volatility is 10%. That means, when the yield changes by 1%, the bond price inversely approximately changes by 10%. That's the meaning. Everybody following or not? Now, about all this, more details should be discussed using Malkiel's theorem. Can I proceed or not? Now, this is regarding the volatility of the bond. This formula can be further simplified. Some books like this. What is duration? 1 plus y by y. Perpetual bond duration is what? 1 plus y by y divided by 1 plus y. This 1 plus y, 1 plus y can get cancelled or not? Simply the volatility is 1 by yield. The volatility of perpetual bond is nothing but what? 1 by yield. Gives you the volatility. Write down alternatively. Volatility of a perpetual bond is volatility of a perpetual bond is 1 by YTM. Volatility of a perpetual bond is 1 by YTM. 1 by YTM. This can be understood as follows. 1 by YTM. This can be understood as follows. Right. V is equal to D by 1 plus Y. Volatility is equal to duration by 1 plus y. Which is equal to, what is duration? 1 plus y by y divided by 1 plus y. 1 plus y by y divided by 1 plus y. 1 plus y and 1 plus y gets what? Cancel. Is equal to 1 by y. Is equal to 1 by y. Okay. With this, we have completed how many types of bonds? 3 types of bonds. Don't get irritated. What is the value of a plain bond? Present value of the n-year coupons, n-year redemption. What is the value of an annuity bond? Present value of the installments. What is the value of a perpetual bond? Present value of the perpetual coupons. All the 3 discounted at the required return of the value, which in turn depends on the risk of the bond. Right or not? Next, second bond. What is the YTM of a plain bond? How many ways to calculate? 3 ways. 2 shortcut formulas and IRR calculation. IRR should be calculated using what method? Trial and error method using a guess rate. Obviously, you can use the shortcut formula rate to be the first guess rate. Everybody, can I proceed or not? Now, for the annuity bond, the only way to calculate YTM is what? IRR. How you calculate IRR? Discounted cash flow is equal to cash flow into annuity factor R% N years. We find out the IRR. For perpetual bond, what is YTM? Coupon divided by price. That's all. Are you all following or not? Now, duration of a plain bond can be calculated using how many methods? 2 methods. Table method, formula. What the formula? 1 plus y by y minus 1 plus y plus p into c minus y divided by c into 1 plus y power t minus 1 plus 1. For annuity bond also, how many methods? 2 methods. Table, formula. Then the formula becomes smaller. What is the formula? 1 plus y by y minus t by 1 plus y power t minus 1. For a perpetual bond, we don't have table, only what? Formula. What is the formula? Much more simpler. 1 plus y divided by y. The first bond alone goes for the formula. Right or not? And finally, we are having what bond? And we are having the volatility. Volatility everywhere is what? Duration divided by 1 plus yield. But for the perpetual bond alone, it can be simplified as what? 1 by yield to maturity. These are all the issues we discussed in the bond valuation. Right or not? Now, the last bond is what? Zero coupon bond. Now, perpetual bond pays coupon, no redemption. Right? Zero coupon bond pays what? No coupons, only what? Maturity value. Very simply, zero coupon bond is something similar to your fixed deposit. When you put the money in fixed deposit, they give a maturity value or not? Only thing is, in fixed deposit, normally you deposit a whole amount, you get a number in odd. I deposit 1 lakh today, it becomes 1,73,152 rupees after what? 5 years. Like the maturity value is there or not? In zero coupon bond, I deposit at a discount, it will be redeemed at par. I deposit at what? Discount, will be redeemed at par. The difference between the purchase price and the Par value redemption will be the time value of any compensation. Everybody following or not? Now, let us see once again. Value, value, YTM, duration, and volatility of a zero coupon bond. The zero coupon bond very simple only, but asked number of times in the examination. Can I proceed or not? Now, all this calculation seems simple because we discuss in a structured way the entire chapter, yes or no? Otherwise, suddenly some numbers will be given. What is calculated, why is calculated, you don't know. Everything is same only. The subject is very simple. Only thing is what we are doing, we should be knowing. Are you following us? Now, we are going to complete the first segment fully after completing the concept of zero coupon bond. Okay, let's take the question and then do a zero coupon bond. Before that, before I go to zero coupon bond, 1 or 2 questions are left out in that particular bonds in the workbook. Let us complete 11, 12 and 13 in another 5 minutes and then go for the zero coupon bond. Right, question number 11. Please take question number 11. Don't talk, please. Ten minutes, yeah, I'll switch off, okay. Now only switch on, right? Okay, please. 12% coupon bond has a maturity of 5 years. Don't talk, please. It pays interest semi-annually. Its yield to maturity is 5% per half year period. What is its duration? One of the ISW examination problem. Okay. Now, please. Question asks you to calculate what? Ask calculate what? Duration. This is a plain bond or annuity bond or perpetuity or zero coupon bond. It's a plain bond because it pays how much coupon? 12% coupon and redeems after how many years? 5 years. This bond is having an YTM of how much percent? 5% per period. They give 5% per period. Everybody following or not? Now, the coupons are paid semi-annual. Now, a plain bond duration can be found out in 2 ways. Table approach and then what? Formula approach. In this problem, I cannot use a table approach. Right or not? I don't know the coupon amount, I don't know the face value, nothing is known. Yeah, correct? I don't have any rupee details in this sum. So I don't have what? Any rupee details in this sum. In that situation only formula can be what? Used. Because in formula I require only 3 numbers. I want Y, I want C, I want T. I want Y, C and then what? T. Tell me why, what is Y in this problem? 5%. Straight away because per period they given. Now what is C? Don't say 12%, convert into periods. How much percent? 6%. What is T? 5 years or 10 periods or 10 periods. I know Y, C and then T. Can't I put into the formula and then do it or not? Write down. Now question number 11. Write question number 11. Question number 11. Facts. Write down. Facts. YTM is equal to how much percent? 5% per period. YTM is equal to 5% per period. Coupon is equal to fill in the blanks. How much percent? 6% per period. Coupon is equal to 6% per period. Term is equal to how many periods? 10 periods. Term is equal to 10 periods. Just to get a confirmation for clarity, this bond is trading at par. In the bond market, is this bond trading at par? Will not trade at par. Why it will not trade at par? Because coupon and yield are different. Now tell me, it will trade at premium or discount? It will be trading at higher than par value or less than par value. Why higher than par value? Because the bond gives you a 6% coupon. I ultimately earn only what? 5%. That means I pay a higher price to buy and a lower amount to redeem. Yes or no? I have a capital loss or not? No. Nothing required for this. Just an observation. Can I proceed or not? Let's start with the calculation. Right? Duration is equal to, please. Duration is equal to, first write the formula. Duration is equal to 1 plus y by y minus, duration is equal to 1 plus y by y minus 1 plus y plus 1 plus y by y minus 1 plus y plus t into c minus y, 1 plus y by y minus 1 plus y plus t into c minus y divided by c into 1 plus y power t minus 1 plus 1 plus y, sorry, c into 1 plus y power t minus 1 plus y. Finish writing the formula or not? Can you substitute or not? No. Y is 5%. Now how you write 5%? 0.05. Right? 1.05 divided by 0.05. 1 plus y by y na 1.05 divided by 0.05 minus 1.05 plus 1 plus y plus 1.05 plus, what is t? 10 into 0.06 minus 0.05, c minus y na 0.06 minus 0.05 divided by 0.06 into c into 0.06 into 1 plus y power t is what? 1.05 power 10, 1.05 power 10 minus 1, 1.05 power 10 minus 1 plus 0.05 plus 0.05 plus 0.05. Everybody respond yes or no? No. If I simplify, believe me, it will be 7.89 periods. So duration is 7.89 periods. Periods na half years. Yes or no? 7.89 periods. If I adamant in wanting to express in years, how many years? Or 3.95 years. Or 3.95 years. Or 3.95 years. With this, we have completed solution to question number 11. Everybody respond yes or no? No. Take question number 12. Please take question number 12. 10-year annual annuity has a yield of 9%. What is its duration? Tell me. This is a plain bond, annuity, perpetual, zero coupon. Annuity bond. Always first understand the bond type. What bond? Annuity bond. They ask you to calculate value, YTL, duration or volatility, duration. Duration of an annuity bond can be calculated in how many ways? Two ways. One is using table approach. Second is using formula approach. Can you use the table here or not? No. Why can't I use table? I do not know the annuity amount to discount. Yes or no? Then I have to use only what? Formula. Tell me for annuity formula, how many data are required? Two data. One is what? The yield. Another is what? The term, because it requires y and then t. Annuity does not have what? C. Ennappa, right or not? So, yield and term are given or not? Yes. What is the term of the bond? 10 years. What is the yield here? 9%. Can't we proceed or not? Write down. Next, question number 12. Right, question number 12. Facts. Facts. Bond type. Facts. Right, bond type. Tell me the bond type is what? Annuity. Facts. Bond type, annuity. YTM. What is YTM? 9%. YTM 9%. Next is what? Term is equal to 10 years. Term is equal to 10 years. Term is equal to 10 years. Now we should calculate what? Duration. Write the formula. Duration is equal to. Duration is equal to. Tell me the formula. 1 plus y by y minus t by 1 plus y power t minus 1. 1 plus y by y minus t by 1 plus y power t minus 1. t by 1 plus y power t minus 1. Substitute the numbers. What is 1 plus y by y? 1.09 divided by 0.09 minus 1.09 divided by 0.09 minus 10 by 1.09 power 10 minus 1. 10 by 1.09 power 10 minus 1. 1.09 power 10 minus 1. If I simplify, I will be getting duration as 4.79 years. The duration is 4.79 years. 4.79 years. Can I proceed or not? Now, next question number 13. Take question number 13. Okay. Perpetual bond has YTM of 10%. What is its duration? What is the duration of a perpetual bond? 1 plus y by y. Write down. Next. Question number 13. 1 second answer. Duration is equal to, right? Duration is equal to what? 1 plus y by y. Duration is equal to 1 plus y by y. Y is how much percent? 10%. 1.10 by 0.10. Duration is 1.10 divided by 0.10. Simple here. Duration is 1 plus y divided by y. What is yield here? 10%. 1.10 divided by 0.10 is equal to how many years? 11. The duration is 11 years. Duration of a perpetual bond is 11 years. Duration is 11 years. Now, respond up to this. Everybody comfortable or not? With this, you have completed question number 11, 12 and then 13. Can I move to the next stage or not? Now, give that thing zero coupon bond. Please. Shall I proceed? A zero coupon bond of rupees 10,000 has a term to maturity of 8 years and a market yield of 10% at the time of issue. Please. What is the issue price of the bond? I add one more question. A question over no. Have it as A. Have one more question A. Right. If the bond is trading at 4,000, please note down. Question A. If the bond is trading at 4,000, if the bond is trading at rupees 4,000, if the bond is trading at rupees 4,000, find yield to maturity. Second question is, if the bond is trading at rupees 4,000, find yield to maturity. Find yield to maturity. One extra question I included to make it comprehensive. Can I proceed? Next. What is the duration of the bond? What is the modified duration of the bond? What will be the percentage change in price of the bond if the yield declines by 0.5% or 50 basis points? That's a question which has been asked. Okay. Now, good morning, friends. Good morning, sir. Are you all with me or not? Yes, sir. Those who said no, raise your hand. I heard no, yeah. Can I proceed? No. See, always concentrate. Sometimes things seems to be very similar, or it may not be enthusiastic or interesting us, but still we have to learn everything, because even a small point may be tested in the examination. That is why I am discussing all these routine issues. You should know the structure what I am discussing. I completed plain bond, annuity bond, perpetual bond. We are discussing about the last bond called as what? Zero coupon bond, in which I wanted to discuss how many points? 4 points. Value, YTM, duration and then volatility. As simple as that. Right or not? Now, can I start doing the sum? Now, zero coupon bond. Forget zero coupon bond. Any bond, what is the value? Value of a bond is a present value of the future cash flows discounted at required rate of return of the valuer. Respond yes or no. Zero coupon bond alone Be careful in English. Okay. Don't say present value of the future cash flows. Present value of what? Future cash flow. Only once you get what? Inflow from the company, that is at what? Maturity. The amount already agreed by the company. Right or not? No. This company now wants to issue a zero coupon bond. Wants to issue what? Zero coupon bond. For how many years? Will it pay anything in first year? Second year? Like it pay only in what? 8th year. How much it pays? 10,000 maturity value. Yes or no? So now this company wants to issue a zero coupon bond that is going to give a maturity of how much it pays? 10,000. After what? 8 years. The company wants to give its investor an yield of how much percent? 10%. Now, should it price the issue now at 10,000, less than 10,000, less than 10,000? At some price, the yield should be what? 10%. At what price? Present value of the 10,000 discounted at 10%. Everybody, yes or no? So the value of the bond is the present value of the 10,000 received after 8 years. Discounted the required yield. How much percent? 8%. Can I start or not? And the first question, what is the issue price of the bond? Can I proceed? Let's do it together. Write down first. Part A. Issue price of the bond. Part A. Issue price of the bond. Question 14 now. Part A. Issue price of the bond. Okay. Tell me, the company wants to price the bond issue to give the investor how much percent yield? 10% yield. Can I say 10%? Okay. Now, by the cash flows, year, event. Next column is what? Cash flow. Present value factored. What is the required yield? 10%. And discounted cash flow. Year, event, cash flow, PVF at 10% discounted cash flow. The buyer of the zero coupon bond from the company will get the cash flow at which year? 8th year. Will be getting the money at which year? 8th year. What is the event year? It is maturity value. The event is maturity value or maturity, anything. What are the cash flow? 10,000. I want 10% present value factor for 8 years. What is 10% PVF for 8 years? What is going to be? 0.4667. Tell me, what should be the price of the bond? 4,667. 4,667. Now, very simple. If the company issues a zero coupon bond today at how much price? 4,667 rupees and redeems after how many years? 8 years. At how much rupees? 10,000 rupees. The investor of this bond will be getting how much percent yield? 10% yield from the company. Respond yes or no? In other words, if I write like this, here cash flow. You are the investor. You subscribe in IPO. You subscribe in what? IPO. Initial public offer of the zero coupon bond. At how much rupees? 4,667. You invest the money or not? No. You don't see anything from the company. You keep on waiting. Up to how many years? 8 years. 8th year, a bulk amount comes. How much amount going to be? 10,000. In the case, how much you earned? You earned a 10% yield from this particular zero coupon bond. Everybody, yes or no? Can I proceed further? No. In part A, the issue price of the bond should be how much? 4,667. Continue writing. If the company issues the bond at 4,667, if the company issues the bond at rupees 4,667 and redeems after 8 years at 10,000 and redeems after 8 years at 10,000, if the company issues this bond at 4,667 and redeems the bond after 8 years at rupees 10,000, then it gives its investor an yield of, it gives an investor an yield of how much percent? 10%. It gives its investor an yield of 10%. Okay. Now, tomorrow the zero coupon bond starts trading in the stock market. How company make IPO of equity shares and then start trading in the stock market or not? Today the company issues the bond at how much rupees? 4,067. Tomorrow morning, when I saw the stock market, the zero coupon bond price crashed to how much rupees? 4,000. Suppose you go to the market and buy the bond at how much rupees? 4,000 rupees. Will you get the 10% yield? More than 10%? Less than 10%? 10% more or less? Why you say more? Because they pay 4,667. I get how much? 10%. Tomorrow the bond is trading at 4,000. I'll be getting what? More than 10%. So what is the yield to maturity? IRR. Everybody, yes or no? Right on. Next. Part AA. I just included the part AA question or not? Right? Part AA. YTM if the bond is trading at 4,000. YTM when the bond is trading at 4,000. YTM when the bond is trading at rupees 4,000. YTM when the bond is trading at rupees 4,000. Can I proceed up? No. Just want to understand. First write the cash flows. Year and then cash flow. Tomorrow you enter into a stock market, give a buy order. Give what order? Buy order for this bond. You buy tomorrow at what price? So the amount invested is 4,000. You put 4,000 into the market and the company will give you after, how many years? 8 years. How much rupees? 10,000. Gives after 8 years, 10,000. I think you are all able to understand or not? No. Tell me, this is a single cash flow, annuity, perpetuity, multiple animal, single cash flow. How to find out IRR for a single cash flow? Future value is equal to present value into 1 plus R power n. Remember or not? No. Write down. Future value is equal to, please write, future value is equal to, along with me do it, present value into, tell me the number, 1 plus R power n, tell me the formula 1 plus R power n. Substitute the numbers. The bond matures how much rupees? 10,000 rupees is equal to what is the present value? 4,000 into 1 plus R power a, into 1 plus R power a. Rearrange. 1 plus R power 8 is equal to 10,000 divided by 4,000. 1 plus R power 8 is equal to 10,000 divided by 4,000. Is equal to how much here? 2.5000 is equal to 2.5000. That means 1 plus R is equal to 8th root of 2.5000. 1 plus R is equal to 8th root of 2.50. Very simple here. 1 times square root gives you square root. Another plus gives you what? 4th root. 1 more plus gives you what? 8th root. What's the number here? 1.1213. 1.1213. 1 plus R is equal to 1.1213. R is equal to how much here? 0.1213. or how much percent? 12.13%. 0.1213 or 12.13%. That is how we should calculate the IRR for a zero coupon bond. Respond yes or no. Now, suppose it's not 8th root, it is 9th root. Now what you will do? Type the 2.5, take square root 15 times minus 1 divided by 9 plus 1 into is equal to 15 gives you the number. Everybody following or not? Now, with this we have complete part A and then what? Part AA. Namely we have completed the price of the bond and then the YTM. Now can you go to the part B of this question or not? Please, everybody. Shall I proceed up? No. See. Part A, issue price of the bond. We found how much is 4,667. That it got us 65. It is nothing wrong. Can I proceed or not? No. I think we got us 4,667. 2. Correct. What the value? 4,667. No? I had 4,665. It is due to the last 2 decimal rounding off. Can I proceed? No. Please don't talk. Issue price of the bond over. Now let's calculate the duration. Now wait here. Let me calculate and then we can just copy it later. Here cash flow present value factor at 10%. What is so second about 10%? YTM for the original question. then discounted cash flow, and then proportion duration. Can I proceed above? Now, tell me, zero coupon bond, 1 to 8 years, 8th year. What it gives in 1 to 8 years? 0. What in 8th year? 10,000. What is the annuity factor for 8 years? 5.3359. Answer, that is, assume that 8th year present value factor is 0.4665. That is 4667 you wrote. That 2 rupees, leave it. Okay, next. Discounted cash flow is 0. 4,665. The bond price is 4,665. Yes or no? What the requirement 8 years? 0. 8th year is going to be what? 1. And a 4665 by 4665 gives you what? 1. So the duration is how many years here? 8 years. Respond, yes or no? No need to calculate anything. Duration of a zero coupon bond is its maturity. What duration here? Is its maturity. That's all. Are you following on? Yeah, zero coupon bond maturing after 11 years. What the duration? 11 years. Yeah, zero coupon bond maturing after 2 years. What the duration? 2 years. Because zero coupon bond has to recover its entire price only in the last year, because in between nothing you can see from the bond. Yes or no? Bond irukaliya எனக்கு தெரியாது. Okay, I only see my demat account to see the bond, that's all. I don't have any communication from what? Company, because I get nothing in first year, nothing in second year. It gives the entire amount in what? The last year only, along with the interest. Right or not? That means the entire principal is blocked for how many years? 8 years. Because not even a single rupee I get what? Before 8 years. So the duration of a zero coupon bond is always what? Is always what? Maturity. Everybody, are you following on? Realized YTM of zero coupon bond will be equal to YTM. Accepted? Yes, because in coupon bond, I get 11 rupees in first year. I can reinvest at different rate. I can get 11 rupees in second year. Reinvest at what? Different rate. So the realized YTM can be different than what? YTM. Zero coupon bond, nothing they give you. They keep on reinvesting what? Money at the same YTM only. YTM will be equal to what? Realized YTM, because I have nothing to reinvest. Everybody yes or no? When there is no reinvestment rate given, we assume to be compounding at what? 10%. Discounting also at what? 10%. So the YTM is equal to what? Realized YTM for a zero coupon bond. Are you finding the conclusion or not? Now tell me, zero coupon bond, what is the value of a zero coupon bond? What is the value of a zero coupon bond? Present value of the future cash flow. Right or not? Next. What is the YTM of zero coupon bond? IRR. How to calculate IRR? Future value is equal to present value into 1 plus R power n. Duration of a zero coupon bond, what is it? Maturity. That's all. And volatility obviously is duration divided by 1 plus YTM. Everybody following or not? Now. Next. The next issue we discuss is what? Volatility of the bond. The volatility has got another name. It is called as modified duration. What is volatility? Modified duration. And a duration I modify by dividing by what? 1 plus y. I call as volatility. To put it simply, it is a duration second derivative. I will be getting what? The volatility. So they give it a name called as what? Modified duration. So tell me, what is the name of volatility? Modified duration. The duration, what we say, no, there is another name called as Macaulay duration. What duration? Macaulay duration. So duration which we calculate is now generally called as Macaulay duration, and the other name for volatility is what? Modified duration. If the exam asks you to calculate modified duration, they ask you to calculate what? Volatility, because duration is modified to find out what? Volatility. D by 1 plus y is volatility, yes or no? In mathematically, it is a second derivative of duration. When I modify, I get the volatility. Derivative means differentiation. Everybody following or not? Now, I'll just derive the volatility formula at the end of the bond chapter. Can I proceed or not? Now. So now, next question is what? Please read the next question here. Take question number 14. What is part C? Modified duration. Write down part C. What here? Okay, copy it. Okay, now copy quickly. Don't draw and all. Copy only the words and numbers. In examination, all this calculation need not be done. I only did it to convince that the duration of a zero coupon bond is its maturity. May ask why it is its maturity? Because nothing is received earlier. Entire amount blocked for what? Full 8 years. Exam simply duration is maturity for a zero coupon bond. Finish copying, huh? Stop talking, please. Finished, huh? Those are not copied, raise your hand. Okay, write down. Part C. Modify duration or volatility. Modify duration or volatility. The formula simple. Volatility is equal to what plus what? Duration divided by 1 plus YTM. Volatility is equal to duration divided by 1 plus YTM. What is duration here? 8. YTM is 10%. 8 divided by 1.10. 8 divided by 1.10. The volatility is 7.273%. Number correct above? Volatility is 7.273%. Volatility is 7.273%. What is the meaning of that? When the yield of a zero coupon bond changes by 1%, then the price of the zero coupon bond inversely approximately changes by 7.273%. Respond yes or no? No. The question is, what will be the percentage change in price? I am reading point D question. What will be the percentage change in price of the bond if the yield declines by 0.5%? Generally, in the interest rate markets, 1% will be called as 100 basis points. A percentage will be called as what? 100 basis points. Suppose RBI wants to hike the interest rate by 0.25%. How they say? 25 basis point. They want to change the interest rate by 3%. How they say? 300 basis point. Always a percent is equal to 100 basis point. One should understand. Can I proceed or not? No. Now, the interest rate in the market is increasing or decreasing? Is going to decrease by how much percent? 0.5%. When the interest rate decreases, answer my question, the bond value is going to increase or decrease? Increase. How much percent will increase is a question. Are you following or not? No. Should I calculate a straight away use a volatility? Volatility. 1% change, the bond value changes by 7.273%. If it changes by 0.5%, then how much is it? 3.636%. It increases or decreases? Increases. Write down. Next, part D. Part D. If the yield declines by 1%, part D, right? If the yield declines by 1%, the bond value will increase by 2.273%. 7.273%. If the yield declines by 1%, the bond price will increase by 7.273%. If the yield declines by 1%, the bond price will increase by 7.273%. Is my yield declining by 1%? No. Write down. Hence, if the yield declines by 0.5%, hence, if the yield declines by 0.5%, bond price will increase by, if the yield declines by 0.5%, bond price will increase by, 7.273% into 0.5, bond price will increase by 7.273% into 0.5, 7.273% into 0.5 is equal to how much? 3.637%. 3.67%. Will increase by 3.67%. Can I check this or not? No. Let's go for the check. Let's do it together. Check. Okay. First, YTM 9.5%. And now the YTM is 10%. It has dropped to how much percent? 9.5%. YTM is 9.5%. Now, That means the value of the bond is present value of the 10,000 discounted by how many years? 8 years. At what percent? 9.5%. Respond yes or no? No. Next is bond price is 10,000 divided by, I am just calculating the present value, 10,000 divided by 1.095 power 8. 1 by 1 plus r power n. Yes or no? 1.095 power 8. 1.095 power 8. If you want, take the calculator, check it here. Take the calculator, 1 divided by 1.095. Type it, 1 divided by 1.095 is equal to how many times here? 8 times. Tell me what is the factor you are getting, what is the percent value factor? 0.4838. So 10,000 into 0.4838 gives you what? 4,838. 4,838. 4,838. Now, tell me, when the YTM was 10%, the bond price is how much here? Well, bond price 4,665 or 667 as the case may be. When the YTM dropped by 0.5%, the bond price decreased, increased. So how much rupees? 4,838. Right on. Bond price when YTM 10%. Bond price when the YTM is 10%. Bond price when the YTM is 10%. How much rupees? 4,665. Bond price when the YTM is 10%, 4,665. So you need not write once again. Increase in bond price. Increase in bond price. What increase in bond price? 173. Now from 4,665 shoot up to 4,838. Increase in bond price 173. This 173 increased from which price? 4,665. So the percentage increase is 173 divided by 4,665 into 100. Percentage increase is 173 divided by 4,665 into 100 is equal to how much percentage? 3.71 percentage. Is equal to 3.71 percentage. We got volatility as how much here? It is 3.637. It is only approximate. Yes or no? We got 3.71 percentage. So this is the answer for the zero coupon bond. Everybody, yes or no? No. This is one of the past examination problem. Okay. Answer my question. How many bond types have been covered? 4 bond types. One last summary. Then you can go for the immunization. Tell me first of all. Value of a plain bond. What is the value of the plain bond? Present value of the n-year coupon, nth year redemption. What is the value of an annuity bond? Present value of the n-year installments. What is the value of a perpetual bond? Present value of a infinite coupon. What is the value of a zero coupon bond? Present value of the maturity value. All just discount at the required rate of return be influenced by the risk of the bond. Yes or no? Now, point number 2. YTM. YTM of a plain bond can be calculated in 3 ways. One is what? Shortcut formula 1 and 2, and then what? IRR. IRR calculated using the guess rate, arrived using the shortcut formula. Annuity bond, how to calculate the YTM? IRR. How to calculate IRR? Discounted cash flow is equal to cash flow into annuity factor used to calculate the IRR. Third is what bond? Perpetual bond. How to calculate YTM of a perpetual bond? Coupon divided by price. Zero coupon bond, how to calculate YTM? Future value is equal to present value into 1 plus r power n. Are you listening? Next is duration. Duration of a plain bond can be calculated in 2 ways. Table approach, formula approach. What is the formula? 1 plus y by y minus 1 plus y plus t into c minus y divided by c into 1 plus y power t minus 1 plus y. For annuity bond also how many methods? 2 methods. Table and then formula. The formula is what? 1 plus y by y minus t by 1 plus y power t minus 1. Zero coupon bond, perpetual bond, only formula. What is the formula? 1 plus y by y. Zero coupon bond, nothing to calculate. The duration is what? Maturity. That's all. The maturity years. What is volatility? Duration by 1 plus y for all the bonds. For perpetual bond alone, volatility calculated as what? 1 by yield to maturity. All this has been discussed in the bond chapter. Can I proceed or not? Now, given the heading, bond immunization strategy. Given the heading, bond immunization strategy. Okay. We can discuss this concept of immunization with the help of a problem. Okay. Question number 19 we will start discussing. Take question number 19. Okay, listen. I cannot straight away tell you what is immunization. We have to have lot of background discussion. In the flow, we will be understanding consequently the concept of immunization. Like a story, we will discuss question number 19 while we are building up the concepts. Okay. Most of the discussion are already known to you. At the end, I will make a observation. That observation gives you the concept of immunization. Can I listen or not? Now, during immunization discussion only, we understand the use of duration much more clearly. What is duration can be understood in much more clarity only during the immunization strategy discussion. Can we start or not? Now, take this question number 19. X wants to invest rupees 1000 for a 4-year period and wants a YTM of 12.6% on his investment. He is considering two bonds for the purpose, bond A, bond B. Bond A and B both are having the market price of 1000 rupees. Both are having a par value of 1000 rupees. The YTM is 12.6% for both the bonds. The coupon also is 12.6 for both the bonds. Term of bond A 4 years and term of bond B 5 years. Duration of bond A less than 4 years and that of bond B is 4 years. Require state factors that will affect the yield from a bond. Which bond should he invest to immunize himself against the yield change? If the market yield of the bond of this risk class drops to 10% in year 2, show how your bond selection helps the investor immunize himself against the yield change. Is a question that is being given. Okay. Now, you need not read the required part. First, go through the data given, that is the table given, go through it and the first paragraph. Then we can just start with our discussion. Can I start up? Now, first of all, we should understand that a good investor should always make investment with a time horizon in mind. Okay, he should know for what period he should be investing. Okay, without any plan, no person should be investing. I may be investing for my retirement. I am investing for my what? Retirement. In that case, the time horizon may be up to what? 48 years or 50 years in an annuity plan and then start getting an annuity pension. Right or not? Or I may be investing for my children's education or what? Marriage. In that case, will be horizon for how many years? 10 years or something. I may be investing to accumulate money to purchase my house. In that case, I want to decide in how many years I have to go for what? Investment in property. In that basis, I will be investing what? The money and so on. So anybody who wants to invest, if you don't invest that way, it is a wrong way of investing. Are you following what I am saying? Any person who wants to invest should know why we are investing money. I am earning, so I am investing. That should not be the attitude. I am investing for some purpose. Always one should know the purpose for what? Investment. Once you know the purpose, we will know for how, at what time that money will be what? Required. Then you go into the market, keeping in mind the time horizon. Are you following or not? So, every investor, a logical investor, will go into any investment, whether investment in equity shares, where if I buy an Axis Bank share, means I should know when I have to come out, yes or no? Otherwise, you become a speculator. Yeah? If you want to make a serious investment, I am going to be in that share for another 3 years, another what? 5 years and so on. Anybody making investment should be knowing how long he is going to be there inside that market or inside the investment. Right or not? This is what we call as the time horizon for investment. Everybody following up? Now, let us understand the facts. Our person, X, wants to be in the bond market for how many years? He is having a target period that I want to come out of the market after how many years? 4 years. Because he may have some commitment after what? 4 years. Either purchase of a house or something. But he wants to be in the market for how many years? 4 years. He fixed a target that I want to be there for how many years? 4 years. He also wants what return he wants. He says, I want to be there in the market for 4 years. I should be earning how much return? He enters the market with the return also in mind. I should invest in the security, give me how much return? 12.6% yield. So now his target is to be there in 4 years and come out enjoying how much yield? 12.6% yield. This is his target. Yes or no? In this process, he just searched the bond market and identified 2 bonds. Identify what? 2 bonds which are giving an YTM of 12.6%. What are 2 bonds here? Bond A and bond B. Bond A and bond B is trading now in the market at what price? 1000 rupees par value. Its par value also is what? 1000 rupees. That is why what is equal to what? Coupon is equal to YTM. In a Kadaba, the coupon also is 12.6. YTM also is what? 12.6 because I am buying at par, redeeming at par. That's what. Okay. If it is say coupon is only 10%, then I'll be willing to pay what? Lesser amount for the bond, but in this example it is trading at par, redeeming at what? Par also. So there are 2 bonds which are giving me an YTM of how much percent? 12.6%. The coupon also happens to be what? 12.6%. This is a coupon paying bond. Everybody following now? Now, bond A is a bond which is having how many years life? 4 years. Bond B is having how many years maturity? That means if I buy a bond A, if I buy what? Bond A, what is that the investor will be getting from this bond? Coupon for how many years? 4 years and redemption at the end of the 4th year. A person buying bond B will be getting what? Coupon for 5 years and redemption at the end of the 5th year. Point number 2. Everybody following or not? And one more detail is bond B, bond A duration is less than 4 years. Do you understand or not? Why it should be less than 4 years? Because maturity itself is what? 4 years. It's not a zero coupon. Bond is pays what? Coupon. I'll be having a duration less than 4 years. That you understand or not? Yes or no? No. In case of bond B, the duration will be equal to what? 4 years. I already calculated and put it. I don't want you to calculate duration. Hence I calculate and put it. We can check it now whether it is 4 years or not. But I won't give you time to copy it. Are you following? Now I'll check it, but I don't give you time to copy it. We know how to calculate duration or not. I don't want to waste time in calculating the duration. So the duration of bond B is what? 4 years. This is the issue. Okay. In this, I want to make some conclusions. What it is, I'll tell you as I progress with the discussion. Everybody, can I proceed or not? Now, let's start with our discussion. Patiently listen. We'll be cornering the concept after some time. Can I proceed or not? Now, first. Understanding facts. The investor's time horizon, how many years he wants to invest, is how many years? 4 years. 2 bonds are available in the market. Both gives its requirement. What is the requirement? 12.6% yield. Bond A has a duration of less than 4 years. In a maturity 4 years. Now since it pays coupon, somewhat gets recovered earlier or not? Duration less than 4 years. And bond B coupon is how many years? He is having a duration of 4 years. Bond A has a duration of less than 4 years. Maturity 4 years and the bond is a coupon being money less than 4 years. Bond B has a duration of 4 years. Given in the question, it can also be checked as follows. Can I proceed now? Now, let's take bond B alone. You should not copy it. Listen here. Now, tell me. I am writing now bond B. Kadaba, tell me, what are all the cash flows from bond B? 1, 2, 3, 4, 5. Okay, 2 5s. Can I proceed? Now, what is the cash flow? 126. In a par value 1000, 12.6% coupon. Accepted. What is the cash flow? 126 coupon, 126 coupon, 126 coupon, 126 coupon. 15 I get what? 126 coupon, 1000 redemption. Gives you what? 1126. Respond. Are you following or not? No. What is the yield to maturity? 12.6. Already the calculator also can be understood that since purchase at par, redeemed at par, YTM is equal to coupon. 1 divided by 1.126. I want participation. 1 divided by 1.126. How much? 0.8881 is equal to 0.7887 is equal to 0.7004 is equal to 0.6220 is equal to 0.5524. Respond yes or no. If you multiply the cash flow, if you get a discounted cash flow, 126 into 0.8881 and so on. You can believe my multiplication. The total is 1000 rupees. Yes or no. The proportion is 111.9 by 1000 gives you 0.1119, 0.0993, 0.0882, 0.0783 and 0.6220. If I multiply the duration with the years, I get what? The duration as 4 years. You have to believe me. The duration how many years here? 4 years. It has been proved. Yes or no? Should you copy or need not copy? Need not copy. Duration already over. Right or not? What I wanted to prove is bond A is having a duration of less than 4 years. That is not another. Why it is less than 4 years? Because the maturity itself is what? 4 years. Zero coupon bond, bond A will be having what? 4 years duration. Coupon bond means what? Recovers earlier. The duration is less than 4 years. Yes or no? And for bond B, I calculated the duration to be 4 years and given the question itself. I think you are all following or not? No. That's all. Facts are over. I did not discuss anything more. What I discussed is what? Facts. Now, our investor wants to be in the market for how many years? 4 years. He wants to earn how much return? 12.6. For him, how many bonds are given that return? 2 bonds. Name the 2 bonds. A and B. Both gives you what? 12.6 yield to maturity. Difference is A is a bond for how many years? 4 years. B for how many years? 5 years. But A duration is less than 4 years. B duration is that's the issue. Can I proceed? Now, the question is, which bond I should invest? In A or B? Question arises now. Okay. Now, I'll tell you the conclusion and then start with my discussion. What they say is, you should invest in a bond not with a life equal to your time horizon, but with a duration equal to your time horizon. That's the concept. I want to be in the market for how many years? 4 years. Don't search for a 4-year bond, search for a bond having a duration of 4 years. This is the conclusion. Having a duration of 4 years. Why should I not invest in a 4-year bond? Why should I invest in what? A bond with a duration of 4 years. He is only going to be discussed in this area called as bond immunization. Everybody following or not? For that, let us first start calculating realized yield to maturity for both the bonds and then continue our discussion. Can I proceed or not? No. So, I think we can complete the discussion. We'll do the copying in the next class. Can I proceed or not? Now, let's start with our discussion. Please. Calculation of realized yield to maturity. Settle down. Good morning, friends. Good morning, sir. Let us start. Now, what is yield to maturity? What the bond gives to the bondholder. What is realized YTM? What the bondholder ultimately earns. I may give you 12.6%, but it is not necessary that you should earn what? 12.6% because what you ultimately earn not only depends on what the bond gives, it also depends on what you do with the money given by the bond. Yes or no? Now, the bond gives 12.6% yield. You invest back the money at 11%. Can you earn 12.6? No. The realized YTM what? Drops. The bond gives you 12.6% yield. You are able to invest back at 14%. What happens here? Realized will be going to be what? More than 12.6. Bond gives you 12.6. You also invest back at what? 12.6. Then you will be earning what? 12.6. Ennappa, yes or no? No. As an investor, I am worried about yield, realized yield. That is what ultimately I take home. Right or not? So I am always worried about what? Realized yield. This investor after 4 years wants a realized yield of how much percent? 12.6. The bond is giving 12.6. I should also take home what? 12.6. Yes or no? But this nobody can guarantee in bond paper. Because tomorrow at what rate I reinvest depends on tomorrow's interest rate. Today I have opportunity to invest at what? 12.6%. Same risk class bond can give me what? 12.6. After 1 year, when you go back to invest, the interest rate may increase or interest rate may decrease. What yield a bond was giving 5 years back is not giving now. Yes or no? Now, in that case, always, ultimately what I take home is risky because my realized yield also depends on what I am doing with the cash flow. When I go to invest back, the interest may have increase or decrease. Now, the first thing what I am going to do is, interest is not changing. Interest is not what? Changing. Next 4 years, he is going to see what? The market interest rate is what? Same only. Everywhere the rate is how much percent? 12.6%. So not only the bond gives him 12.6, he will able to reinvest also back at what? 12.6%. That is the assumption number 1. Yes or no? Let's see what happens and then change the assumption and see what is going to happen. Can I proceed or not? Now, see. We all know how to calculate realized ATM. How many steps are there? 3 steps. First is what? Reinvestment table. Second step is summary. And third step is calculation. Right or not? Now, tell me the reinvestment table. I do for bond A and then what? Bond B. Carefully follow every discussion I make. Year 1, year 2, year 3, year 4. I am going to be there how many years here? 4 years. Again, recollect. Bond A is a bond with how many years life? 4 years life. Bond B how many years life here? 5 years life. Now, you put the money in bond A. You put the money in what? Bond A. First year company gives you 126. Second year gives you. Third year gives you. Fourth year gives you 126. And the company gives a redemption check for how much? 1000. It is 1126. Everybody, yes or no? Now, come to bond B. Company first year gives how much? 126. Second year. Third year. Fourth year. Company give you only 126 because company redeems after 5 years. If you want to get a redemption check from the company, you should be holding the bond for how many years? 5 years. Yes or no? But I want to get out in what year? 4th year. That means I will not get the redemption from the company. I have to sell the bond in the market. That is, if I want to come out early, I cannot wait for the company to redeem. The indenture redeems only at the end of what? 5th year. Now, I cannot get the redemption value from the company. Instead, I should sell the bond in the market at the end of 4th year. Yes or no? If I sell the bond today, I sell at P0, price today. If I sell the bond at the end of 1st year, I sell at P1, price 1. Yes or no? Like that. If I sell at the end of the 4th year, I sell at what? P4. Correct? I sell at what price here? P4. I sell at what price? P4. What is the price of a bond? Present value of the future cash flows. At the end of the 4th year, the cash flow is going to be a single cash flow coming at the end of the 5th year or not. So, the present value of the future cash flow discounted by what? 1 year gives the price at the end of the 4th year or not. Correct? Now see, I have to calculate the P4 of the bond. Okay, now. P4 is equal to cash flow 5 divided by 1 plus R. Bond is having 1 more year life. At the end of the 4th year, it becomes a 1 year bond. Now, at the end of the 4th year, person is going to purchase from you. He is not buying a 5 years bond, buying only one 1 year bond. He gets how many cash flows? 1 cash flow. That is what the cash flow 5. Yes or no? Then he discounts by what? 1 year and pays a price 4. Are you following? Now, what a bond purchaser will get in 5th year? 1126. He will get 126 coupon and 1001 redemption. And he is willing to pay a present value of that. Yes or no? You discounted what rate? At the rate prevailing on that day. Today yield may be 12.6 and tomorrow may be what? 11 and so on. Daily interest rate changes or not. So he will pay the price only on that day interest rate. Yes or no? We assume that interest is not going to change. So he will discount at what rate here? 12.6. That means I hope that I will be able to sell the bond at what price? 1126 divided by what? 1.126. You're going to how much rupees here? 1000 rupees. Everybody, are you following? Now, this 1000 rupees I am getting from the company, getting from the investor. Because I am not redeeming, I am only what? Selling in the market. Tell me why I get exactly 1000? Because I want, that is the interest rate is 12.5, 12.6%. Coupon also what? 12.6%. Anytime when the coupon is equal to what? YTR, the bond will trade at par. Are you following what I am saying? If he wants not 12.6, he wants what? 14%, then he will discount the 1126 by what? 14% and willing to pay less price. Yes or no? If he wants only 8%, then he'll discount at what? 8% and pay what? More price. So the price depends on the yield on the date. It's all no yield and price is having inverse relationship. Everybody following or not? So now the cash flow, how much base? 1,126. How I got it? 126 from the company and 1,000 from the market. Everybody yes or no? Ultimately, A and B has the same cash flow. Person from whom I may get may differ. The cash flow is what? Same. Now, to consolidate, if I buy bond A and keep it for how many years? 4 years. What the company will give me? 126, 126, 126, 126 and 1000 in a 4-year bond. If I buy a bond B, what the company will give me? 126, 126, 126, 126. Company will not redeem. I have to sell in what? Market. I have to sell in which price? P4. What is P4? 50-year cash flow discounted by 1 year. The discount rate is same 12 points because yield did not change. So it becomes same 1000 which I got from the market. Everybody following or not? No. Tell me. Every year when I get a coupon, I put in my pocket. What I will do? Reinvest. I reinvest at that time's prevalent rate. Is the interest rate changing or not changing? Not changing. I invest back at what? 12.6%. Yes or no? Now, please tell me reinvestment table. I invest these two cash flows at 12.6% for how many years? 3 years. Then 12.6% for 2 years. 12.6% for 1 year. How many years here? 0 years. Everybody, are you following or not? Now, if I find out the maturity value, 126 into 1.126 power 3. Can you believe me, numbers are not? I just compounded. Both the columns should be same because cash flow is also same, factor also same. If I total, it is going to be 1607.51, 1607.51. Everybody following or not? Tell me. Today, how much I invested? How much I invested here? 1000. Anything I got in first year? No. Because what I got, I invested back. I did not get anything in first year. I did not get anything in second year. I did not get anything in third year. Not anything in what? Fourth year. At the fourth year end, how much I got? 1607.51. Ennappa right or not? Tell me, how I got this number? 126 into 4. Sollappa, 126 into 4 gives how much a base? 126 into 4 gives how much a base? 500 and? Okay, plus what? 1000. The bond gave me 1504. How it become 1607? The balance is reinvestment income at 12.6%. Everybody following on. That's how the amount matured to 1607.51. Reinvestment table over. I think I'll have the clarity or not? No. If I invest in bond A, the company gives me all this money, which I invest back at what? 12.6. At the end of fourth year, in my pocket or in my bank, I'll be having how much a base? 1607.51. Same thing happens for bond B also. When I calculate realized YTM, ES0 invested how much? 1000 and got how much? 1607.51. For this, can I calculate IRR or not? Tell me what IRR calculation? Future value is equal to present value into 1 plus R power n. Yes or no? Now tell me what is future value? 1607.51 is equal to what is present value? 1000 into 1 plus R power 4. The top I have typed wrongly. Make a change. We'll copy it. Can I proceed? Now 1 plus R power 4 is equal to 1767.01 divided by 1000. 1 plus R is equal to what? 4th rule. Very simple. Plus square root 2 times. I'll be getting R as how much percent? 12.6%. Because why R is 12.6%? YTM also 12.6%. Reinvestment also is what? 12.6%. Realized yield also what? 12.6%. Everybody up to this, are you following or not? Is anything new learned or everything old? Everything is what? Old. Only thing is, if I hold for 4 years, I cannot get the redemption from the company. Sell for what? P4 is the only new thing we have learned. Everybody up to this, are you comfortable? Yes, sir. Let me go to the next stage of discussion. From this, I say like this. For a bond holder to ultimately earn how much percent? 12.6%. He should have in his hand 1607.51 at the end of the fourth year. If the money in his hand is more than this, he should have earned more than 12.6. If the money in his hand is less than this, he should have earned what? Less than 12.6. To earn 12.6, what should be the cash flow in hand at the end of fourth year? 1607.51. To get this money, I am dependent only on bond. I depend on two things. The bond cash flow and the reinvestment income. Bond cash flow and then what? Reinvestment income. Bond cash flow sure because it is a committed number. When I buy the bond, company cannot back it. SEBI is there to protect me. Yes or no? It may be Sahara also, but SEBI is there to what? Protect me. Yes or no? In that case, bond cash flow signed, no problem. But there is no guarantee that I will be getting 12.6% reinvestment income. Right or not? It may be more than that, less than that. It all depends on interest rate prevailing at the time when I go to reinvest. Are you following? Now, the question is, what happens if the interest changes? If the interest remains same 12.6, I will be able to what? Earn 12.6. Now, if the interest drops to how much percent? 10%. Will I get 1,607.51? Question arises now. Will I get that? Will not get that? Will not get. The reason is very simple here. Because the reinvestment income has dropped from 12.6% to what? 10%. Then I will not be earning realized YTM of 12.6%. Are you following or not? Let us check that with bond A and bond B and then go for a final discussion. Everybody following or no? Don't worry. I'll complete another 10 minutes. Are you following or not? No. Because I cannot cut now. Because I have to start once again from what? Beginning in the next class. That too will come later. I cannot summarize also. Can I proceed? No. We can copy later. Conclude and then proceed. Investor wants to be in the market for how many years? And he wants how much return? He wants to invest how much today? 1,000. That means at the end of the fourth year, what should be the money in his hand? 1607.51. He identified a bond with how much return? 12.6. Is that sufficient to protect him? No. Because the 1607 not only depends on the bond's 12.6% yield, it also depends on what? His ability to reinvest back at what? 12.6. That rate can I guarantee or not? No. Nobody can guarantee because interest rate is a macroeconomic factor. Exchange rates, interest rates, or inflation rates, all are what? Macroeconomic factor. It is country specific, not a company specific. Are you following what I am saying? In that case, it is beyond my control or not. In that case, suppose second year interest drops to 10%. Question given. If you read the question, what happens here? In the second year, when I go to invest, the interest drops to what? 10%. When I say second year, at the beginning of the second year, yes or no? This year interest, now don't say end. We always say what? Beginning. When you go to invest in second year, beginning of the second year, the interest drops to how much percent? 10%. In that scenario, what happens to bond A? What happens to bond B? Can we discuss or not? We'll calculate the number once again and then go for the conclusion. We will be completing today's class. Can I proceed? Now. This is already discussed. So YTM of 12 points can be sustained only if the bond cash flows can be invested at 12.6. Calculation of realized YTM when from year 2 general interest rate decreases to how much percent? 10%. That means I can reinvest back at 12.6 or 10% or 10%. Can I proceed or not? No. I'll do for bond A first. Okay, please. Okay. What bond A gives? First year 126. Who gives? Company gives. Second year 126. Who gives? Company gives. Third year 126. Fourth year 1126. Everything got from company in a 4-year bond. Yes or no? This 126 I'll invest back at what rate? 10% because I get this at the end of the first year 126. Today evening again, tomorrow morning when I go to the bank, second year, the interest rate, there's an announcement, drops to what? 10%. I'll be happy or crying? Because I'll be investing back at what percent? 10%. 1.10 power 3. Are you following up? No. Next, I invest at what? 1.10 power 2. 1.10 power 1. 1.10 power 0. Don't look at calculation. Believe my numbers. If I multiply, I'll be getting how much rupees here? 1584.74. Yes or no? No. Can this 1584.74 give me a realized yield of 12.6? 1607 only gives me what? 12.6%. 1584 gives me what? Less than 12.6. Tell me why my realized yield has dropped? Because yield is 12.6%. Investment back at what? 10%. Dilution yield takes place. Are you following what I am saying? Can I proceed? No. Can I go to bond B or not? No. So bond B is our hero. Why bond B is a hero? It is having a duration of 4 years. They are only going to start the discussion. Can I proceed? Now, come to bond B. 1, 2, 3, 4. Answer. First year, how much I get? 120. Who gives? Company gives. Second year, who gives? Company. Third year, 120. Who gives? Company. Fourth year, company will give 126. But I have to sell in what? Market. At what price? P4. P4 will not be 1000 because they want 10% yield. Bond is given 12.6% coupon. The price should increase. Ennappa, right or not? So, what is price for? Present value of the future cash flow. Fifth year cash flow discount to fourth year. At what percent? 10%. That is the required yield in the market at that time. Yes or no? When I sell the bond, people are not expecting 12.6, they expect only what? 10%. You are having a bond giving 12.6% coupon, whereas they want only what? 10%. They'll pay more price or less price or more price. Let's see what is the price for. Everybody following or not? Now, see, price for is equal to, are you able to see the slide or not? 1,126 rupees is a cash flow I get in what? Fifth year. I discount how much percent? 10%. 1.10. The price is 1,024. Is or no? Tell me, why they are willing to pay 1,024 price? Because they want a 10% yield. Your bond is giving 12.6. They are willing to pay a premium for your bond. Yes or no? How much to pay? 1,024. At the end of the fourth year, I sell in the market this bond for how much to pay? 1,024 and get how much coupon? 126 from the company. The money in my hand is how much to pay? 1,150. Everybody, yes or no? Now, I invested at 10% for 3 years. 2 years, 1 year, 0 year. Reinvestment of the cash flow at the current yield. If I multiply, I'll be getting a number 1608.76. That 90 paise and I'll leave it here. It is only rounding off. I get the same number 1607.76. Yes or no? My yield to maturity and realized yield is still 12.6%. That means bond me is protecting me. Is what? Protecting me from whatever interest rate that changes in the market. Market interest rate may increase or what? Decrease. Still, I am assured of how much yield? 12.6. The reason is I invest in the bond not with the life of 4 years, the duration of what? 4 years. Why it is so will be the next discussion. Are you following? Are you following or not? Now, so what is the conclusion is, if I invest in bond A, if I invest in what? Bond A, 5 years life, my 12.6% yield to maturity need not be what I take home, because what I take home also depends on what? Interest rate change in the market. But if I invest in bond with a duration of what? 4 years, then whatever may be the general interest rate change, still I am earning what? The same 12.6% yield. The yield stands protected. Everybody following or not? Okay. Another 5 minutes, I'll tell you what has happened. Please, just a minute here. Then I'll give you the notes. Now, I have to complete my discussion. 9 o'clock time. 9:15 class timing or not? Now. Nobody should go out. Doors will be locked. Can I go say it now? I'll complete and then leave you. Nothing needs to be copied. We'll copy in the next class. Okay. Now, last discussion. Sir, why bond A yield dropped? I did not earn 12.6 because my realized yield is only less than 12.6. I don't get 1,607. Yes or no? But how bond yield, B yield is able to what? Protect itself is the issue. What is the role of the duration in this regard? Can I proceed or not? No. Let us have this discussion. Very, very important one. See. Can I start or not? No. See, a bondholder has purchased a bond. Tomorrow, when there is a change in interest rate, will he be happier, unhappier? Suppose the interest rate decreases. So, the example for the interest rate what? Decreases. Say, the interest rate is going to decrease. Tomorrow the interest rate decreases. He is happier, unhappier? He is unhappy because he will be able to reinvest at a lower amount. Yes or no? He is unhappy because his reinvestment income what? Decreases. So when the interest rate decreases, he starts crying because he lost the reinvestment income. Suddenly he laughs because when the interest rate decreases, bond price increases, he will make a capital gain out of it. Whenever there is an interest rate change, the bond holder is affected in two fronts. His reinvestment income is going to get hit. Also, his bond price is going to what? Change. When the interest rate decreases, the money received on the bond will be able to be invested back at what? Lower rate. He is going to suffer in the reinvestment income front. Yes or no? But at the same time, a 1,000 rupees bond, 12.6% coupon, if the interest rate drops to what? 10%. People are willing to pay more than 1,000 for that bond. Yes or no? Because he is having a bond with a higher coupon. Are you following what I am saying? In that case, he is going to have a capital gain increase in the bond price. Ennappa right? Suppose the interest rate increases. Interest rate what? Increases. Happy, unhappy? Happy when he is having what? Reinvestment, because interest rate becomes 14%, his coupon can be invested back at what? 14% and not at 12.6%, right or not? He is happy because the reinvestment income what? Increases. But what happens? The bond value decreases because everybody wants 14%, your bond gives only what? 12.6% coupon, the bond value what? Reduces. He is crying because of the loss on the bond value. So no. So always interest rate change is good as well as bad for the bondholder. It's good and bad in both fronts. Reinvestment income as well as what? The bond price. Everybody following or not? Now, see, what happens is bond A holder in our problem, interest rate decreases to 10% or not. Bond A holder had suffered reinvestment income. But he could not make capital gain because he did not sell in the market. He got an agreed redemption value. Say, whatever may be the interest rate, the company shall pay only what? 1,000. He is not able to capitalize on what? The interest rate decrease and capital gain front because he held the bond till what? Last day company shall pay you only 1,000. I will not give 1 rupee extra. Are you following what I am saying? That is why when I hold the bond till maturity, I cannot hope to make what? A capital gain due to the interest rate loss. Are you following or not? That is why bond A gave me a lesser cash flow. Yes or no? But the beauty of bond B is it suffered 10% reinvestment loss. I don't deny it. But at the same time, it made 24 rupees capital gain. Yes or no? Yes, that capital gain is able to what? Offset the reinvestment loss. That offsetting will be exactly equal if the bond is held till duration. Are you following that? It should be exactly offsetting each other. The bond is held till what? Duration. Now, it is something like a balance. Okay. Don't think that all balanced, center only it should be there. Sometimes the weight may be what? Different. This balance here. Now I can say this is year 5. This is what? 1 to 4 years. And this is called as what? 4th year. This 4th year is what? Duration. Now what they say is 10% when the interest rate drops, I lose reinvestment income for this 4 years or not? No. This loss will be offset by just enough cash flows in what? 5th year, we are able to compensate that. Are you following what I am saying? Now, if I shift this to this period, if I shift to what here, in that case what happens is, the reinvestment income loss or gain will be less than the capital gain or loss. Are you following or not? Another cash flows I am discounting for future become much more larger. When the cash flows discounted are larger, the capital gain or what? Capital loss may be bigger. Everybody following what I am saying? So now again I say reinvestment income is how much percent? 10%. Drop down. Now if I hold the bond till 4 years, I lose 10%. That is reinvestment income for the 4 years or not. The loss of reinvestment income is exactly recovered by what? The capital gains. Capital gain depends on two things. Number of years cash flows which you are discounting and the discount rate. Everybody yes or no? No. In that case, suppose I hold the bond for how many years? 3 years. For example, I hold a bond for how many years here? 3 years. Now write like this. You know how many years? 3 years. 1 to 3 and then what? 4 and 5. Now answer my question. Reinvestment income increases to 15%. How much percent? 15%. Happy or not? Happy because I earn extra reinvestment income. How many years here? 3 years. But I suffer capital loss or not? But the loss is not going to occur for a 1 year cash flow, occur for what? 2 years cash flow. This capital loss may be more than the reinvestment gain. Yes or no? Suppose I had held the bond for how many years? 4 years. Duration, what a beauty. If I held for what? 4 years. This reinvestment income gain or loss anyway will be exactly offset by what? The capital gain or loss. That is the meaning of a duration. Everybody yes or no? What the duration? It is a optimum holding period of the bond. If you hold the bond till duration, then the remaining cash flows will generate a capital gain or loss due to the interest rate change. That capital gain or loss will be exactly offset by the cash flows that is received on which reinvestment has been what? Earned, which can be more or less. That is the meaning of a duration. Everybody following or not? So now tell me, should I buy a bond with a life of my time horizon or duration? Duration only helps me protect against what? The yield change. Respond. Are you following? This we call as bond immunization strategy. Immunize means what? Protect. You do immunization, vaccination, immunization, no, it means what? Protect. Here, the strategy of purchasing a bond with a duration equal to your life is going to protect you against what? Yield change. Against what? Yield change. Whatever may be the change in interest rate, I stand protected. Is called bond immunization strategy. Everybody have the clarity or not? Next class we'll copy the solution along with.
Thank you friends. OMSAI Bhojanapalli.